A very good morning, friends. So I hope you made a revision of what we covered in the last class yesterday. So we were doing Ind AS 115, and so far we have just done some bit on step number 1. To recap a little in terms of few minutes, what we discussed in the yesterday's class was I had first of all given you the exposure on the three terms in the name of the standard. We understood the difference between revenue and income, understanding that income is a wider term as compared to revenue. And then we looked at the word contract in terms of the standard. The contract is between the two, you can say reporting entity and the customer. These are the two parties. And then we also saw that what is a customer, that is who pays the consideration to the reporting entity. Then I took you to the concept of a five-step model, and I just introduced you to the five-step model. And I guess you now clearly remember that what are the 5 steps in terms of the standard. As I just give you knowledge that this standard is a joint project in terms of FASB, the Financial Accounting Standard Board, and the IASB. So it's a blend of a rule and a principle-based standard. On the per se level, you can see that it's a rule-based standard because it got a 5-step model in it. And we identified the 5-step is number 1, identify the contract. Number 2, identify the performance obligation. Number 3, determine the transaction price. Number 4, allocate the transaction price to the various performance obligations. And then finally, recognition of revenue, which is based on the timing factor. Do we consider a revenue on a percentage completion method, or do we consider a revenue on a completed contract method? And then before we began the journey on the 5-step model, I had also given you the clarification on the scope of the standard. We just did one insight in terms of the scope of the standard. And we said, if you're looking at a barter deal, a non-monetary exchange, then there are 3 permutation combinations. It is only one combination where Ind AS 115 does not apply, and that is a situation where, number 1, the entities are in the same line of business. That's one parameter, and the objective is not commercial in nature. The idea is only to facilitate the sales. There is no commercial objective in the deal. So the moment you say that the exchange is between different entities in different line of businesses, Ind AS 115 is applicable. And even if there are in same line of business and there is a commercial substance, Ind AS 115 again gets triggered in this case. In that particular case, revenue recognition would take place. And I also clarified that the revenue which you're going to record in this case is the fair value of the consideration which you receive. Unlike when you acquire an asset by way of exchange, we always consider a book value or a fair value of what we gave in order to acquire an asset. But in terms of revenue, it is always the consideration received. So we need to consider the fair value of the non-cash consideration which we receive. That becomes a revenue for the recipient, for the receiving company. Then I made an exposure on the step number 1, and I gave you a simple 3-step model. Now this 3-step model was not a part of the standard. This is something which I've given you as a part of convenience. And I said you need to apply the step number 1A, 1B, and 1C. At the first instance, you need to see in step number 1A that the 5 conditions which are stated in para number 9 is met or not. If you say yes, they're met, we're ready to go to the main step number 2. But if you say that these conditions are not met, you need to go to the step number 1B and see if there is any advance which you received from the customer. Now, if you've not received any advance from the customer, it's a matter of reassessment of those para 9 conditions. And if you say yes, an advance is received, we go to the step number 1C. And in that case, in 1C, we start looking into the 3 set of conditions or the 2 set of conditions. So you meet either all the 3 conditions or you meet either the 2 conditions. If yes, the advance can be treated as a revenue. But if the 3 set of conditions or the 2 set of conditions is not met, then the advance is treated as a liability, and along with which you also need to make a reassessment in terms of the para number 9 conditions or the 3 and 2 set of conditions, whichever is met earlier. Accordingly, the accounting treatment would follow. Then I mentioned into the special issue discussions with you, and I made a one special issue discussion, which is a combination of contract. And I also give you a little insight in terms of the para number 4 vis-a-vis the para number 17. Ind AS 115 also allows an entity to use what we call a portfolio approach. But the use of the portfolio approach, as I said, is purely optional on the part of the entity. But if you're looking at the para number 17, it's a mandatory para, which means that once an entity triggers para number 17, in those particular cases, it has to combine the contract. And I give you two triggering parameters. I'm not reminding you all that. I'm just giving you the basic framework of what we have discussed yesterday. So the moment you say that the two triggering conditions are met, the para number 17 becomes applicable, and then you need to meet any one of the conditions, and in which case you are going to treat the two contracts may be entered separately, but of course at or near the same time, and it is with the same customer or a related party, then they are combined and treated as one. So now, before we go to the step number 2, there is some technical discussion, another special issue of discussion with you, that is contract modifications. Now, let me first of all, I think, tell you friends something. Now, I'm not scaring you in the morning itself, but I'm telling you, yesterday was not a technical day. Yesterday, we just did some very warm-up exercise with you, understanding some basic components of the standard. But today is going to be a little heavy. So I would, of course, request that please give me a very, very patient listening. And of course, if you've got any questions, I'm of course going to take up your questions there and then. If you want any particular concept to be repeated, do ask me, because I have two major agendas, technical major agendas for discussion. One is a contract modification, and one is the concept of the step number 2, identifying the performance obligations, which I generally feel people falter a lot. But I promise you that if you would give me a good hearing, a patient listening, you will get a good grip on both the contract modifications and the step number 2. That's, of course, my contractual constructive obligation towards you. Terms and conditions apply. Okay, so I think let's start the journey, and let's start with the concept of contract modification. So what I'm going to do in terms of contract modifications, again, I am going to develop a 3-step model. Sir, this 3-step model, is it a part of the standard? No. I've created this 3-step model on contract modifications for the ease of understanding and applying it to practical illustrations. But before that, I am going to use certain para numbers with you. And this is going to make a life a little simple. So today I'm going to use a few para numbers. You need not remember the para numbers. You need not remember the para numbers. This is just for ease of convenience, that at the start, to elaborate the particular concept, I'm going to pick up some para numbers with you. So don't get worried that do you need to remember the para numbers or not. But this is just to give you a complete good explanation of things. So let me see in the meantime if there is any questions coming in. Then I can first take your questions. Very good morning, Shriram. Good morning, Viraj. Good morning, Namrata. Good morning to all of you. Okay, so let me start the journey, friends, with you. And I'm starting the inputs with you on the concept of contract modifications. So first of all, let me remind you, we are discussing a special issue related to step number 1. I'm discussing a special issue relating to step number 1, and that's what we are calling as contract modification. We're calling it as a contract modifications. Now, let me first explain what is the concept of a contract modification. The standard very clearly says that a contract modification means that there is a change. There is a change either in the price of the contract, or there is a change in the scope of the contract, or there is a change in both. So let's get this one thing very clear. So when you say that it is a contract modification, you can say, I would say there are two things to be seen, that both parties mutually agree. Both parties have mutually agreed to modify. So both the parties have mutually agreed to modify the contract. That is one. And secondly, what did they do? They made certain changes. Now, this change could be in terms of either an increase or in terms of decrease. Let's get this one thing very, very clear. So when I'm looking at a contract modification, we are looking at two inputs when you start out with a question. The very first input, what you're looking at is that both the parties have mutually agreed to modify the contract. So they entered into a contract, and at a later date, they agreed to modify the contract, but it's a mutual assent. It's a mutual assent that, both the parties have mutually agreed, because if it is not the case, it can be something called, later we go to study the concept. Let's not get into that. So both the parties have mutually agreed to modify the contract. So this is called a contract modification. The mutual agreement could be either increase or decrease in terms of either the price or the scope of the contract, or it can be price and the scope both. You increase the price, you decrease the price, you enhance the scope, add on some more units, or you decrease the number of units as a part of the existing contract, or you make both the changes, then it is treated as a contract modification. So when you go to see a practical illustration, get very clear that at the first instance, when you read a question, you should very clearly see that the question very clearly mentions that yes, it is a case of modification, that both the parties have sat down and they've agreed to change the price, scope, or both of them. Correct. This is one. Now, let me just take you to some relevant paras now on this, and it's given in the study material as well, but I'm just going to create a three-step model for the ease of convenience. Now, let's, I think, first of all, take you to some relevant inputs out here, which deals with the concept of contract modification. So let me give you the chain of thought. So we've got para number 20 and we've got para number 21. So we've got para number 20 and we've got a para number 21. Let me zoom it slightly further so that we can see the language very, very clear. Now, just read it very carefully with me, because I am going to develop a three-step model on this based on what we read. It's going to take a little time, 5-10 minutes, so patiently just hear this well. It says an entity shall account for a contract modification as a separate contract. We are given the inputs. Entity shall account for a contract modification as a separate contract. It is entered as a separate contract if both the following conditions are present. Now, let me create, first of all, your thought process. In terms of Ind AS 115, hear this very carefully what I'm saying. In terms of Ind AS 115, I am not concerned with the legal form of the transaction. I am concerned with the substance of the transaction. Let's say, for example, a reporting entity and a customer entered into the contract. And then they did something what we practically call, they made an addendum. I guess you know what is an addendum. That means you are adding an extra page to the existing contract. So there are two, you can say, parties to the contract, a reporting entity and a customer. They entered into an agreement and they entered into some kind of additional contract, but they decided to add an addendum to the contract. Now, the lawyer made an addendum, but I am looking at as a chartered accountant and I'm saying, boss, you've created an addendum to the existing contract, but this is a separate contract, boss. Are you getting my point? So I am challenging what the lawyer is doing. So the lawyer must have added an addendum to the existing contract stating that it's a part of the existing contract. But I'm going to look at the substance of the transaction and I'm going to make a challenge to that from the accounting perspective. I'll say, no, you might have created an addendum to the existing contract, but I'm sorry, it is in substance a separate contract altogether. So that means the substance is going to prevail over the legal form of the transaction. I hope I'm very clear with my inputs. So it says an entity shall account for a contract modification as a separate contract. So even if the parties say that it is a modification to an existing contract, I'm saying no, it's not to be treated as a modification from the accounting point of view. We're challenging that it's not a modification. Something which the parties agreed that this is a modification to an existing contract. We are saying no, it's not a modification to the existing contract. It is to be treated as a separate contract provided both the conditions are met. So we are going to treat the modification as a separate contract if the two conditions are met. Let's have a read on the two conditions. So it says the scope of the contract increases. So one of the important element is that there must be increase in the scope. What do you mean by increase in the scope? Let's say, for example, if the existing contract was to supply 1,000 units to the customer, now the entity has agreed to supply another 200 units to the customer. So there is a scope increase because you've agreed to supply additional number of units as a part of the existing contract. So there must be increase in the scope. It says because of the addition promised goods or services that are distinct, another key word. Now you would ask me that what do you mean by that these additional goods and services are distinct? We are going to understand the word distinct when we come to the step number 2, that is identifying performance obligation. So don't get worried on the word distinct at this stage. So we will understand this word distinct when I come to you on step number 2, that is the main step number 2, identifying the performance obligation. So don't get worried on this term at the moment. But what is important in the clause number 1 is that there are two conditions. The scope increases and the additional goods and services are distinct. There is one condition, but it has got two conditions in the first one. It says that the goods and services, additional goods and services are distinct and the scope of the contract is also increased. Then he says the price of the contract increases, the scope increases, the price increases. The wording is very clear. There is an increase in the scope, there is an increase in the price. The price of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional goods and services. Let me explain that. Let's say, for example, I entered into a contract with an entity to supply 1,000 units at the rate of 100. My existing contract is that I said I'm going to buy 1,000 units from you at the rate of 100 rupees a unit. Then I again entered into, I said, let me modify the contract. I want another 200 units. And I said, I want another 200 units. He said, I'll supply at 110. He said, I'll supply at 110. I said, boss, I bought those initial units at the rate of 100. Now you're charging me 110 rupee. He said, मुझ पर एक एहसान करना कि मुझ पे कोई एहसान मत करना. He said, I'm not concerned that you're my existing customer. I'm going to charge the same price which prevails in the market as of today. If you would not have been my existing customer, I would have charged the same price. Anybody who comes to me today, I'm going to charge him on the basis of the standalone prices prevailing today. The reporting entity does not give any kind of favor because you're an existing customer. They deal with you based on the prices which are prevailing in the open market at that point of time. I know the question which is coming to your mind. So let's say, for example, in the same case, the prices have fallen down, let's say to 90. Now, if the reporting entity agreed to supply those 200 units to you at the rate of 90, which is the prevailing market price, he did not give you any favor that you are an existing customer. He did not reduce the price. He says that the price is increased, actually more goods at additional price. So you cannot say that the price has gone down in the example. The price of the contract increases. It's the overall consideration which should increase. So you cannot compare that earlier the price was 100 and now the price is 90. Overall consideration of the contract has gone up. the price of the contract increases by an amount that reflects the entity's standalone prices, which means I can say that if earlier you bought 1000 units at the rate of 100, and now you've agreed to buy another 200 units at 110, or you've agreed to buy another 200 units at 90, you can definitely see that there is an increase in the consideration. It says the price increases by an amount of consideration. There is definitely an overall change in the consideration of the contract. Earlier, the consideration was 1 lakh. Now the consideration is increasing because of those 200 units. So the price is on the rise, because the increase should be in terms of the consideration. The price increases by an amount of consideration that reflects the standalone price for the additional goods. To the extent the reporting entity agrees to supply these goods at the standalone prices, we would say this condition is met. I hope I am pretty clear on that. I think there might be a few questions coming in. Okay, I guess, Namrata, you said that if both parties do not agree, then it's not a case of contract modification, because modification has to be approved by both the parties to the contract. Otherwise, it cannot be treated as a modification. Then other implications would apply, which we come to that later. Okay, so we've seen one thing. The para number 20 is telling me, I'm just going to consolidate what para number 20 is telling me. The para number 20 is telling me that you are going to treat a modification to the existing contract not as a modification, but a separate contract. And what are the parameters that you're going to consider it as a separate contract? There are basically 3 parameters if you ask me. There are basically 3 parameters if you ask me. Number 1, the scope increases. Number 2, the additional goods are distinct. We yet to understand what is distinct. And number 3, we can say that there is an increase in the price of these additional goods, and that increase is representing the standalone prices prevailing in the market. The reporting entity did not give any kind of consideration to the fact that you are an existing customer. They provided the goods to you. They provided those additional goods to you at the prices which prevails in the market at that point of time. They never gave you any concession of the fact that you are an existing customer. They're providing the goods at the same price which is prevailing in the market at that point of time. I hope, friends, I am clear on para number 20, right? So before we take it further, let me get your inputs. I hope I'm pretty much clear with reference to para 20. You need to remember the 3 focus points. The scope increases 1, the price increases 2, and of course the price increases commensurate to the standalone price, and the additional goods are distinct in nature. If you're able to prove all these 3 conditions, I would treat this modification not as a modification, but a separate contract altogether. I hope, friends, I'm clear on that. Give me your inputs, then I can take you to the next case. We'll consolidate everything, but I hope I'm clear with the parameters of para number 20. So far, so good, right? Okay, I think I've not got any input so far. I believe it is clear, or maybe you're putting some questions at the moment. Okay, now let me take it further, and I am now going to the next inputs which is given. That is para number 21. So let me just take you to the para number 21 now. So there are some permutation combinations which are given with reference to para number 21. Okay, Manav tells me, yes, we are clear. Okay. Now let's go to the para number 21. And there are now 3 combinations in para number 21 A, B, C. Now let's read. It says if a contract modification is not accounted as a separate contract, that means if para number 20 fails. If para number 20 fails, then para number 21 is applicable. It says if a contract modification is not accounted as a separate contract, entity shall account for the promised goods or services at the date. It says in whichever following ways is applicable. So there could be now 3 possibilities. If you fail the parameters of para number 20, then there could be three permutation combinations, para number 21A, 21B, and C. Now, hear this very carefully because now we are about to enter a little more technical discussions with you. It says in clause A, an entity shall account for the contract modification as if it was a termination of the existing contract and the creation of a new contract. So we are indirectly saying that this contract modification led to a termination. I tear off the existing contract. It's a termination of the existing contract. So we are going to treat the modification not as a modification, but it's a termination of the existing and a creation of a new contract. If the remaining goods and services are distinct, if the remaining goods and services are distinct in nature, I'm not reading further. I'm not reading the accounting treatment, but all I can say, this is technically called a prospective accounting. This is technically called a prospective accounting, that we are saying that you made a change which indirectly leads to the termination of the existing contract, and we are considering that a new contract altogether is come into place. So we need to apply what we technically call a prospective accounting. How does that prospective accounting apply? We will see this very soon. Let's take it further. Okay, then I am doing something else as well. Then I am given something else as well. Let me just read it further. So this was para number 21A. And now coming to the inputs in terms of para number 21B. We'll come to the accounting treatment of para number 21A very soon. But 21A says that if the additional goods are distinct in nature, then you are going to treat it as a termination and it's a new contract altogether. Let's, I think, zoom it slightly further. Okay, now let's have a look in terms of the para number 21B. It says an entity shall account for the contract modification as if it was a part of the existing contract. It's a part of the existing contract. Can you see the language that in para number 20, it says the modification is separate. In para number 21A, it says it's as good as a termination of the existing. And in para number 21B, it says that it is a part of the existing contract. So technically, if you ask me, the para number 21B is the only case where you're treating the modification as a modification. If you technically ask me, para number 21B is the only case where you're treating the modification as a modification because it is being treated as a part of the existing contract. If the remaining goods and services are not distinct, I'm not reading further. Now, friends, I have some very good observation. Let's see if you've got a similar kind of observations or not. Para number 20 was talking that additional goods are distinct. Para number 21A was talking that the additional goods are distinct. Para number 21B is talking that the additional goods are not distinct. Aha. So I think my step number one should be in terms of identifying that the goods are distinct or not. Because if the focus in terms of para number 20 or in 21A is that they're distinct, and in terms of 21B, the focus is that they're not distinct, I think I should start working as my step number one in the main step number, in the contract modification. Are the additional goods distinct or not? So, but you've not yet explained what is distinct in nature. No worry, we'll explain that, but you need to decide, is the additional goods distinct or not? So can there be a possibility that the additional goods and services is a blend of distinct and non-distinct as well? Wow, that's the clause number C. If the remaining goods or services is a combination of A and B, that means it's a combination of distinct as well as not distinct in nature, then the clause C applies. Well, we are not going to get into the para number 21C from an examination point of view. I have not seen any question on that in the study material or in the education material, because that can become a very complicated affair. So we're going to concentrate only on the area that either it is distinct or it is supposed to be not distinct, or maybe it's partly distinct, not distinct, but we're not going to cover that from the examination perspective. Now let's make life a little simpler to you. I'm now going to introduce you to a three-step model, and then we're going to apply this all to practical case studies and all, and you're going to get the concept very clear. Let me start with my three-step model to you. So as I said, this is a three-step model which I am creating only for the ease of convenience. Only for the ease of convenience. It's not given in the standard. This is just to give you a good explanation in terms of things. Now, what is the step number one? Let's make it step number A. So I'm looking at contract modification, step number 1A, whatever you feel like. Let's take it step number 1. The first focus point in terms of step number 1 is you will decide that is the goods distinct or not. Now, how do we decide it is distinct or not is something we will see later. But you got to first of all ask yourself a question, are the goods distinct? So if you say yes, they are distinct, or you say no, they are not distinct. If they're not distinct, you're going to go to step number 3. And if you say yes, they are distinct, you're going to go to step number 2. Get this very clear. So you want to first of all focus on the fact that the additional goods and services are distinct or not. If you say yes, it is distinct, go to step 2. If you say no, they are not distinct, you go to step 3. Now let's see what we're going to do in step number 2. Basically, in step number 2, I am now deciding that do we apply para number 20, treat it as a separate contract, or do we apply para number 21A? Because the common thing between para number 20 and 21A is that they're distinct in nature. So what I'm going to do, I will evaluate the two conditions now. I will evaluate the two conditions. Condition number 1, did the scope increase? Number 1. And I will evaluate, did the price also increase commensurate to the standalone price? You're going to evaluate the two conditions. Did the scope increase and did the price also increase commensurate to the standalone price? If you say yes, then in this particular case, it's going to be treated as a separate contract. It's not a modification, but it's a separate contract accounted separately. Don't touch the existing contract. But if you say no, that these conditions are not met, then in this particular case, we will consider as if it is a termination of the existing contract. As if it is a termination of the existing contract, and we're going to apply what we technically call a prospective accounting. We're going to technically apply what we call a prospective accounting. Then finally, step number 3. In terms of the step number 3, we're going to now, first of all, simply say, because if the goods were not distinct, we need to simply consider that it is a part of the existing contract. So it is a part of the existing contract. So when you say it's a part of the existing contract, you know what kind of accounting applies? Wow. The kind of accounting applied is called cumulative catch-up adjustment. It is called a cumulative catch-up adjustment. So what do you mean by a cumulative catch-up adjustment? I'll tell you something very interesting now. Hear the words very carefully. You know, when you were at the intermediate level, you've done basically two kinds of accounting. One is called prospective accounting. From the date of change, you do the change in accounting. And one is called a retrospective accounting, and that is you do the accounting from the very inception. So we have seen that it's either a prospective accounting or it is a retrospective accounting. There is another third kind of accounting, which is called a cumulative catch-up adjustment, which means it is a retrospective computation. It is a retrospective computation, but it is accounted prospectively. So what do you mean by computed retrospectively and it is accounted prospectively? We see that. But when I say a cumulative catch-up adjustments, it means that you do the computations retrospectively. If I would have applied the change retrospectively, what is the impact? But you don't record the impact in the period, in the previous period. You record the impact in the future period itself, in the period in which you identified the change. That is called a prospective accounting. So computation will be done retrospectively, but accounting will be done prospectively. So that is technically called a cumulative catch-up adjustment. I know what you're thinking. So can you just make a walkthrough on the three-step model once again? I know the mind must be getting heavy, but I gave my disclaimer at the very inception that today is going to be slightly more technical. But if you're going to hear me very carefully, trust me, you're going to get a very good hang on the concept of contract modification, because this is very typical and a technical area. But I think a little patience, listening, and understanding the concept is going to give you a good hold on the concepts. Let me, in the meantime, see if any questions coming at your end. Okay, yes, I think I am getting some questions. Okay, I think Shiram, you said, so in case the remaining goods or services are not distinct, but similar to those of the original contract, then will they be treated as a single contract? Well, I think if you're looking at the application of para number 17 and para number 21, I think let's not get into that. It'll become too technical and messy. So I think let's not get into that. And you said, so para number 21, B and C are not clear. Please explain again. That's what I said. I'm just going to come back to it once again. Okay, Janvi, you said, so can you explain this once again? Of course, I'm doing that. Manav, sir, in step 3, what is a part? Let me, I think, consolidate the picture once again. Now, hear this once again, friends, with me, and you're going to get the entire picture in this case. Let's put this once again to you. We need to understand one important thing, that when you say a contract modification, the first thing which should strike your mind is, what is a contract modification? Now, please hear every word carefully for the next 2-3 minutes. If you're able to get this, trust me, you get the concept. The first thing is, the question rises, what is a contract modification? So when you say a contract modification, we should say there are two parameters. Is the change approved by both the parties? They mutually sat down and they've agreed to make the change. Yes, I said yes, both the parties have mutually sat down and agreed to modify the terms. So I would say, okay, one parameter is met. I'll say, okay, what did you change? Either you change the price, increase or decrease, or you change the scope, increase or decrease, or maybe you made a change in the scope and the price both. So you need to first of all evaluate that if the two parties sit down together and mutually agree to make changes in the price or the scope of both, it is a contract modification. One. Once I know, yes, it's a contract modification, my mind needs to be clear that the contract modification can be treated in 3 different manners. A contract modification can be treated in 3 different manners. I'll be coming to a few questions to you, true and false questions, later after the understanding gets developed. One is, the contract modification is not treated as a modification, but it's a separate contract. Number 2, a contract modification is not treated as a modification, but it is treated as a termination of the existing contract. And number 3, the contract modification is actually treated as a modification. That's called a part of the contract. It's a part of the existing contract. I repeat, modifications which are done by the two parties are treated in 3 different manners. From the accounting perspective, I refuse to treat it as a modification. I say it is a separate contract. Number 2, I refuse to treat it as a modification. I say it's a termination of the existing contract. Or I say, yes, it is a modification. It is to be treated as a part of the existing contract. It is a modification. I'll give you the formal notes later. So I guess I'm pretty clear that what is a modification? Focus 1. The accounting implications of modifications, either you treat the modification as a separate contract, which is not modification. The parties are saying that we have created an addendum and we are saying that this is a modification. I say, boss, it's not a modification. It's a separate contract. Second, the party says we've added an addendum and this is a modification. I say, boss, no, it's not a modification. You basically terminated the existing contract, right? And the third is, I say, yes, it is a modification. You have added an addendum. Yes, it is a part of the existing contract. So there are 3 accounting implications of a modification. Either you treat it as a separate contract, not a modification. You treat it as a termination of the existing contract, not a termination. Or you say that, yes, it is a modification. So therefore, we're going to treat it as a modification. Are we clear till this particular stage, friends? Is this thought process, I guess, clear so far? Yes, I'll give an example, Namrata, no worry. First, I need to give you the concept, before I take you to an example, because unless we know the provisions of the standard, we will not be able to apply it. So you'll have to wait for the examples. Okay, so did you get this input so far? So far, the thoughts only so far. I'm yet to come back to the three-step model, but are we clear that we are treating the modification as a separate, or we are treating it as a termination of the existing contract, or we are saying, yes, it is a modification, therefore it should be treated as a modification. Okay, wonderful indeed. Let's now take it further. Now, I am now deciding, so how do I decide that it is a separate contract, or how do I decide that it is a termination of the existing contract, or how do I decide that, yes, it's a termination? For this, I've created a three-step model. And we need to understand the essence. If you're a little wondering on what is the logic, I'll explain the logic along with as I move on. So I've created a three-step model in terms of deciding that when the parties add an addendum to the contract, then I am evaluating how do I decide which accounting treatment would follow. So follow my three-step model. Focus number one, is the additional goods distinct or not, sir? You need to explain us distinct at this particular stage. Now, friends, very carefully. I'm going to explain the concept of distinct in detail when I come to the step number two, but for the time being, just to give you a little flavor of what is distinct, let me give you a little flavor. I bought 100 units from an entity as a customer. I ordered another 50 units. Do you think these 50 units are capable of independent use, or I need to use them along with 100 units? I bought 100 units from an entity, then I ordered another 50 units of the same product. So do you think there is any interconnection between the existing units? Do you think I need to use them together, or they are capable of independent use altogether? Do you see any interdependence? Do you see any interrelationship? No. There is no interdependence, interrelationship, because when you ordered those 100 units, they are capable of independent use itself. And when you ordered another 50 units, they're capable of independent use itself. So if you say that they are independent of each other, then we say they are distinct. When you say that they are independent of each other, then we say they're distinct if they are interrelated. Let's take another example. Let's say, for example, a customer entered into a contract with a company to build a house. I said, I want a 3-bedroom house. I want a 3-bedroom house. And then I modified the contract. I said, boss, do one thing. Instead of a 3-bedroom house, why don't you also take out one study room as well? So I said it's a 3-bedroom house, but I want to slightly modify and take out one study room also along with it. Do you think it's going to make changes to the existing contract? Tell me. In my second example, do you think I am looking at some kind of changes in this contract? That you are saying that I asked him to build a 3-bedroom house, and then I said, no, please take out a study room as well. Do you think it's going to make some kind of modifications to the existing contract? The person, the reporting entity, will have to do some kind of changes to the existing 3 bedrooms. How will he take out a study room? He'll have to modify the space allocated to those 3 bedrooms and then make the changes, right? Then we will say that it is not distinct. So if you see a connect between the existing and the additional goods, mind it, litmus test. Though we're going to see the details later, we're going to get into deep dive in terms of distinct, not distinct later. But if you see that there is any connection, then it is not distinct. If you see no, there is no connection, it's independent. There is no connectivity, there is no interdependence, no interrelationship between the remaining and the existing goods, then it is distinct in nature, right? So how are we going to do that? Don't get worried on that. When I'm going to take you to the practical illustrations, I'll make a walkthrough of my 3-step model in the next 5 minutes with practical examples with you. Okay, so coming back on the agenda. So now what we are saying, focus number 1, you need to decide, is the additional goods distinct or not? Now let me ask you, friends, logically, Think logically. Now you know what is distinct. Distinct means no connection between existing and additional goods. No connection. Do you think per se I should treat it as a modification? Think logically and answer. I decided that the additional goods are distinct. If they are distinct, do you think I should treat it as a part of the existing contract, or technically it should be treated as if it is a separate contract? What do you say? Think on a logical front. You are telling the reporting entity, I want some additional goods. It has got nothing to do with the existing goods I bought from you. So do you think it should be treated as a part of the existing contract, or should technically be treated as a separate contract altogether? And that is right. I think somebody said, yes, it is a modification. No. What does a modification mean? That you're changing something existing. If your additional goods is not even related to the existing goods, mind you, if your additional goods is not even linked to the existing goods, then why should it be a part of the existing contract? It's a separate contract altogether. I buy 10 chocolates, I eat them, I buy another 5 chocolates from the person. Why should it be treated as, a part of the existing contract? It is technically a separate contract altogether. Therefore, what we said, that if it is distinct, you need to evaluate whether it is a separate contract or not. I can't outrightly say that it is separate. I'll have to do the evaluation whether it is separate or not. How would the evaluation take place? Can I say the contract can be treated separately only if the person does not give any benefit that you are an existing customer? Say yes or no. Can I say you can treat this as a separate contract only if you say, and I'll just come back to you, Shriram, I think on the question, let me just go with the flow first. So can I say if the other person does not give you any benefit that you're an existing customer, it's a separate contract? Makes sense? Right? Makes sense? So you need to evaluate that did you add additional goods, and the price he's charging you is commensurate to the standalone price. He never gave any favor to you on the ground that you're an existing customer. He said, boss, I will charge you the same price which prevails in the market. Don't tell me that you are my existing customer. So if the additional goods are asked for, the scope went up, and the price for these additional goods is commensurate to the standalone price, does it make logical sense that it is a separate contract? Ask yourself a question. As an existing customer, I approach an entity. I say, I want additional goods. He says, I will charge the price which prevails in the market today. Don't tell me that you're an existing customer. If he's not treating me as an existing customer, he charges the price which he would charge to any other customer. Do you think it's a modification or it's a separate contract altogether? It is a separate contract altogether. So the moment you go to fulfill the two conditions, it becomes a separate contract. But now let me ask you something. When you approach the reporting entity and you say, I want additional goods, he says, so the prevailing price is 110. You say, I'm your existing customer. Do you understand that? I have been buying things from you so far, so you can't treat me as a new customer. You need to give this consideration that I am being your existing customer. So let's finish everything and let's create something new. Let's finish everything. What I purchased with you, you only said that if you add on more goods, I'll give you discount at that stage. Forget the existing term. I'm enhancing the scope of the contract. So in this case, it's a termination of the existing contract. I guess you're getting the logical perspective. So if the two conditions are met, that means the entity is not giving a consideration that you are an existing customer. They're treating you as a fresh customer. It's a separate contract. But if they are treating you that you're an existing customer, then it should be treated that as if, you've terminated the old terms and conditions and you started a new journey with the entity. So it's going to be considered as a termination. This treatment applies only when the goods are distinct. This treatment applies only when the goods are distinct. That means they're not related to the existing goods. So if it is not related to the existing goods, it can be a separate contract or it can be a termination of the existing contract. Now come to the step number 3. In terms of the step number 3, if you say that they are not distinct, what does this mean? The building example. 3-bedroom house. Now you want to create a study room into this. Have you modified the contract? Tell me. You said a yes earlier. So if it is a modification, because what is a modification in a true sense? A modification will take place only when the additional goods are related to the existing goods. Mind you, it is only when the additional goods are related to the existing goods, then it is treated as a modification, a part of the existing contract. And there is a special accounting which applies, which is called a cumulative catch-up adjustment. Am I clear, friends, with my 3-step model? Okay, now let me come to your question, Shriram. So while executing the original contract to construct 3 bedrooms, modification proposed to construct 2 bedrooms and instead of 3rd bedroom, make modifications to the contract to construct the study room means that it shall be considered as a modification of the part of the existing contract. Well, I would say in terms of construction contracts, generally, I'm using the word very carefully, generally, it will always be a case of a modification, that means a part of the existing contract, because construction would always consider that this is a case where the goods are not distinct. Though we'll understand distinct, not distinct, more detail later. But are we clear, friends, now conceptually with the 3-step model? Then I think I can take it further. Are we conceptually clear with the 3-step model? Decide it is distinct or not distinct. That's one. If it is distinct, you go to the step number 2. Evaluate the scope and the price rise. If yes, then it is separate. If no, then it is a termination of the existing. And if it is not distinct, that's the only case where it is a true modification and a cumulative catch-up adjustment applies. Okay, so I think we got some yes on that. Now let's do one thing. Let me now read a few questions with you, where we're going to just apply a 3-step model. We're not solving the questions right now. I just want to apply the 3-step model, then I'll document this model. So I'm just going to take you to a few questions on modifications. So let me just share the questions to you on the concept of modifications. Right, so this is the question which is there on modification. We're just going to read 3 questions with you, and you are going to take a call on these 3 questions. So I'm just going to read the facts of the questions, and we're just going to decide whether it is a case of a termination or a case of a separate contract, whatever. We're just going to have a little read on that. Okay, now very carefully, friends, I am just going to see the 3-step model and decide the accounting treatment. How do we do the accounting treatment? We'll see. Let me read the question number 10. It says, I guess that's visibly clear. Let me just zoom it slightly further. Yes, I think that should be good enough. The visibility is good. I think so. Okay. Question number 10, it says, an entity promises to sell 120 products. It says an entity promises to sell 120 products to a customer for 1,20,000. The consideration is 1,000 per unit into 120 units. The products are transferred to the customer over a 6 months period, and the entity transfers the control of each product at a point in time. After the entity has transferred the control of 60 products, the contract is modified. Does this mean that it is a modification? The contract is modified. I've already here put that in red. I said the first thing you need to do is you need to read the language of the question and decide that it's a modification. The question very clearly says that the contract is modified. Now let me ask you, do we accept on the face of it that it's a modification? Quickly come with the answer, yes or no. Do we accept on the face of it? Do we accept on the face of it that it's a modification, or do we evaluate by a 3-step model that it is a separate contract, or it is a termination of the existing, or it is generally a contract modification? Quickly come with the answers. The question is telling me that they've modified the contract. So do we accept that it's a modification, or do we evaluate this? So yes would mean what? That you are accepting that it's a modification, or you're going to make an assessment and evaluation. So you said a yes. What does a yes mean in this case? Are we accepting it as a modification, or are we going to challenge and evaluate based on a three-step model? We're going to evaluate and assess. We're going to evaluate and assess. You're not going to directly accept the fact. Agreed? Great. Wonderful indeed. Okay. Lipica said so yes, sir, because it clearly states no, 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 no. That's what I've been explaining for the past some time. Even if the question says that the parties have modified the contract, don't accept. Don't accept. You need to apply the three-step model and evaluate that is this actually a modification. Let me remind you, if you're treating it as a separate contract, is it a modification? No. If you're treating it as a termination of the existing contract, it is a modification? No. If you're treating it as a part of the existing contract, is it a modification? Yes. Are you getting my point? So you don't have to accept the examiner as it is. You need to evaluate the three-step model. Let's read further. So he says the contract is modified. So one thing is very clear, that they must have mutually sat down. They must have mutually sat down and they made some changes and called it as a modification. But from the accounting point of view, am I going to treat it as a modification or not? Depends. It says to require the delivery of additional 30 units, a total of 150 identical products to the customer at a price of 950 per unit, which is the standalone selling price for such additional goods at the time the order is placed. The additional 30 units are not included in the initial contract. It is assumed that the additional units are contracted for a price that reflects the standalone selling price. I think things are very clear, but let me, now consider this. The very first question what comes to the mind in this particular case is the goods distinct or not? Do you think they are independent? Do you think that there is any connection? Will you be able to use those additional 120 units independently, and will you be able to use those 30 units independently? They're identical. They're not interdependent. They're not interrelated. So can I say, yes, they are distinct in nature? So we can say, yes, it is distinct. So what do? I go to the step number 2. After I decide that it is distinct, I go to the step number 2. Now we need to evaluate number 1. Did the scope of the contract increase? Did the price of the contract increase commensurate to the standalone price? And I think the facts are very clear. Did the scope of the contract increase? It's additional 30 units. Additional 30 units means, yes, the scope went up. Did the price increase? Yes, there is an additional consideration of 950 per unit, which is the standalone selling prices at that point of time. So both the conditions are met. So what do you treat this as? A separate contract. So can I say we reached a conclusion that this modification is not accounted as a modification, but it is treated as a separate contract. Are we clear, friends? Question number 10. Are we pretty clear with the question number 10? I guess well understood with the facts that you need to evaluate. Number 1, it's distinct. And then you go to the step number 2, evaluate the scope and the price, and then decide the scope went up, additional units. The price went up commensurate to the standalone price. Therefore, the entity, let me ask you, did the entity treat me as if I'm their existing customer, or they said, we are going to charge what we charge to the other customer? We are charging you 950, which is the prevailing market price at this point of time. We are not giving you any concession. They never gave you any concession that you earlier bought at 1,000 and now you're buying at 950. They did not do any ihsan on you. They did not consider any favor of the fact that you're an existing customer. They never gave you a discount on the ground that you're an existing customer. They treated you as if you are coming afresh to them. So it's not a modification. It's a separate contract altogether. Okay. Okay, Manav, I think you got a question. So when we say increase in price, we mean the total consideration? Yes. We mean the total consideration, because the wording used is that the price increase is in the consideration. So earlier, the consideration was 1,20,000. Now there is an additional consideration, 30 into 950. So we can say that if you see what is the additional consideration, 28,500 is the increase. So the price is leading to increase in the consideration, which is commensurate with the standalone prices. Correct. Okay, and one of you said, so what if the price per unit decreases due to market conditions or as a favor of being existing customer? Okay, let me ask another question, friends, at this stage to give you more clarity. Same example. Now you need to quickly decide. I said the goods are distinct. Number one, step one. I go to the step number two. Scope went up. Yes. I say the price increase is not commensurate. Let's say the prices prevailing in the market is 100, but the entity charges me 95. So the price they're charging me is not commensurate with the standalone prices in the market. Are they treating me that I am their existing customer? Yes. So what do you treat this as? Because step number two has got two accounting treatment. Either treat it separate or treat that the old agreement is terminated. So can I say if you fail the clause that the price increase is not commensurate to the standalone price, then in that particular case, it is treated as a termination. Right? Okay, great, wonderful indeed. Can we have some rapid fire questions to get more clarity of thought in life? Let's give you some permutation combinations on step number 1 and 2 so far to decide the things. If you can answer this, then I think your concepts are going brilliantly well. Let's, I think, try the permutation combinations to you. Let me put across the questions. My question number 1. The goods are not distinct. The goods are not distinct. Is there only one accounting treatment available, that is cumulative catch-up adjustment? Yes or no? I am saying the goods are not distinct. You decided the goods are not distinct. Is there only one accounting treatment available, that this is going to be treated as a cumulative catch-up adjustment? True or false? Quickly. I know the net takes a little time to get the answers, but I think we got the answer. Yes. Great. Super. That's right, Vidit. That's right, Koshki. That's right, Manav. That's right, Janvi. Absolutely. Number of you said, so additional units are given for existing consideration, then will it be treated as separate? I'm coming to the combinations. No worry. I'm coming to the combinations. Number 2. Can I see if it is distinct, the scope went down? The goods are distinct, the scope went down. Termination. Agreed. So I'm saying that the goods are distinct in nature. The goods are distinct in nature, but the scope went down. If the scope went down, then the condition fails. Can I say it would be treated as a termination? Agreed. True. Wonderful indeed. That's correct again. Okay, let's put the third combination now to you. The goods are distinct. The scope went up. The price went down. Because it's not commensurate. The price is not commensurate. Distinct, scope went up, the price is not commensurate. Is it again a termination? Is it again a termination in this particular case? Wow, that's right. I think that's going great now. The last one indeed. The goods are distinct, the scope went up, the price went up. The scope went up, the price went up commensurate to the standalone price. So do we treat it as a separate contract in this case? Yes. So if the goods are distinct in nature, there can be various permutation combination. Don't worry, I'll give you that permutation combination chart later once I document the notes. Let's see more example. So I think this is going good. Now let's have a look at another one. Let's look at the question number 11. We're deciding now the accounting treatment in question 11. Then I'll explain how do you account for it. It says entity A enters into a 3-year service contract with a customer for 4,50,000, which is 1,50,000 per year. The standalone prices for a 1-year service at the inception is 150. You entered into the contract at the inception, which is at the prevailing prices. Doesn't make a difference to me. I am concerned with the standalone prices when you modify, not at the time when you enter the contract. It says A accounts for the contract as if it is a distinct services. Basanti, tumhara naam kya hai? Is the question telling me that the goods and services are distinct in nature? Yes, it is telling me they are distinct. Step 1 is done. It says at the beginning of the third year, the parties agree to modify the contract. So they modified the contract. That means they must have made a change in the price or the scope of both. Do we accept it or do we evaluate with a three-step model? Let's get this. Do we accept it or do we evaluate? He says they modified the contract, but do we accept or do we evaluate? We evaluate with a three-step model. I am going to make an evaluation in this particular case that whether it is a modification or is it separate or is it a case of a termination. Let's evaluate. It says the fee for the third year is reduced to 120. The contract, the existing contract was for 3 years with a fees of 1,50,000. And I made a decrease in the price of the contract. In the same existing contract, I made a decrease. And then it says C agrees to extend the contract to another 3 years for 3 lakh, which is 1 lakh per annum. The standalone price for 1 year at the time of modification is 120. So is the change in price commensurate to the standalone price? You tell me. Manasa, we have to evaluate, but we should also check if the goods are distinct or not. Why do we take it on the face value stating the question? Well, if the question is whether they are distinct or not, that would be accepted. We are only challenging whether it's a modification or not. We won't challenge the concept that if the goods and services are distinct or not. If the question is stating that it is distinct in nature, we got to accept that fact. Right? So in this particular case now, the question very clearly says that you've agreed to extend the contract 3 lakhs, 1 lakh per annum, but the standalone prices is 120. So is the step number 2 got to fail? Is the price commensurate to the standalone price? No. So what do we treat this as? Separate or termination? So what do you say? Are you going to treat this as separate or a termination? It's going to be treated as a termination because the two conditions are not met. The price increase is not commensurate to the standalone price. The standalone price is 120 at modification and you agreed at 1 lakh rupee. So it's a termination of the existing contract. Okay, that's great. Now let's have a look at the question number 12. Then I'll solve these questions with you. I'll give you notes and we'll solve these questions on a three-step model. Let's read the question number 12. So you can see question 10 was on distinct, separate. Question number 11 was distinct, termination. So you can make a guess that question number 12 is going to be not distinct and it's a real modification in that sense. Let's have a look. It says G enters into an arrangement with a customer for infrastructure outsourcing B. So you basically, entered into a deal with a contractor where it is for infrastructure construction. Based on the experience, G determines that customizing the infrastructure will take approximately 200 hours in total to complete the project and the charges are 150 per hour. After incurring 100 hours of time, G and the customer agree to change the aspect. They agree to change the aspect. And they increase that there is an increase in the estimate of labor hours at the rate of 50 hours at the rate of 100 per hour. How would the modification be accounted for? I said one thing a little while back, that if you're looking at a project which involves a construction, it would always be not distinct. How? I'll explain. I'll underline the word customizing. Wait for my step number 2 discussion, where I'm going to explain the concept of distinct and not distinct in detail. And you will come to know why in a real estate industry, generally, I'm saying that the goods are going to be not distinct in nature. So please accept it right now that it is not distinct in nature. If it is not distinct in nature, this means what kind of accounting treatment I'm applying. Am I treating this modification as a modification? Yes. I am treating this modification as a modification. So what kind of accounting treatment would apply? Cumulative catch-up adjustment. Time now, I think, to document all these notes and solve these 3 questions so that the concept of modification is absolutely clear. Let's begin the journey. So let me now start writing some note friends for you. So just note down these notes. So this is the crux of our discussion so far. So let me just come to the notes, detailed notes on the contract modification. So we are looking at contract modifications. We're looking at contract modifications. I've already given you that when is it a case of a contract modification. So we just going to apply a three-step model on the concept of contract modification. Step number one. Step number one. Are the additional goods or services, underlying additional goods or services distinct or not? Distinct or not? So this is the first question you will put across to yourself, that are the additional goods and services distinct or not? So I'll give you detailed notes later, but let me just make a mention. So see details in step number 2. I'll explain this in more detail in step number 2. Right now, I've just given you a basic litmus test that if there is no connection between existing and addition. So the litmus test you would apply right now for the time being is, the litmus test is if the existing goods and services and the additional goods and services, in this case, if you say that they are related, then I would say it is not distinct. But if you say they are not related, then I would say it is distinct. So this is the litmus test for the time being. More details would come later. So if you see that they are related to each other, not capable of independent use, you need those additional goods to use those existing goods, interdependency, interrelationship is present, then it is not distinct. But if they're independent, no interrelationship, then it is distinct. Okay, so in this particular case, we put across a question, are the goods and services distinct or not? So the answer is either a yes or the answer is a no. If the answer is a no, you go to step number 3. If the answer is a yes, you need to go to step number 2. Simple. So the first focus is purely on the fact that these goods, additional goods and services are distinct or not. Remember, that's the key focus. Then I go to the step number 2. In terms of step number 2, we need to evaluate two conditions. Condition number 1 plus the condition number 2. The condition number 1 is that the scope increases, and the condition number 2 is that the price increases commensurate. The price increases commensurate to the standalone prices. The price increases commensurate to the standalone prices. So you need to consider that the scope increases and the price increases commensurate. If you say yes, both conditions are met, or if you say no, both conditions are not met. So if you say yes, both conditions are met, then we can say that it is treated as a separate contract. It is treated as a separate contract and not technically a modification. So when I say it's a separate contract, we're indirectly saying it's not a modification. And if you say no, these conditions are not met, then it is supposed to be a termination. Then it is a termination of existing contract. It is considered as a termination of the existing contract. And in the brackets, you can make a mention, we will do a prospective accounting. How do we do a prospective accounting? I'll explain in the question. So we're going to apply a prospective accounting in that particular case. So that is my step number 2. I guess if you've taken a note, let's go to the step number 3. So the first test is distinct or not. The second is the evaluation of the two conditions. If met, it is separate. Otherwise, it's a termination of the existing. But you can see one thing very clear, that if the goods are distinct, it's technically never treated as a modification. Because either it becomes a separate contract or it becomes a termination of the existing contract. So the moment the goods are distinct, we are saying it's not a modification. Either you're saying that the old contract comes to an end, or you're saying that it's a fresh contract altogether. Now let's go to the step number 3. And in terms of the step number 3, where we said that the goods are not distinct, we can say in this particular case, we apply cumulative catch-up adjustment. We apply cumulative catch-up adjustment. The accounting treatment is called cumulative catch-up adjustment, which technically means that it is retrospective computation. How do we do that? We'll see. It is a retrospective computation. It is a retrospective computation plus a prospective accounting. It is a retrospective computation with a prospective accounting. How do we do this? We'll see. And so we said we apply a cumulative catch-up adjustment in this particular case, right? So this we can make a mention that it is treated as a part of existing contract. It is treated as a part of the existing contract itself. That is actually treated as a modification. That is actually treated as a modification. So we are technically treating this as a modification itself. We are saying, yes, this is a contract modification in the real sense. Wow. Okay, now I think I need to solve the questions with you. But I think before this, let's create a permutation combination chart as well, so you get a good idea on things. Let's do one thing. Let's play a small little chart with you, a small little game. You can answer the questions if you want in between. And if you want, you can answer the questions as well. Let me see if any questions coming so far. Then I'll take the journey forward. Okay, I think we got a question from Manav. Standard price of labor at the time of modification is not given to determine the price rise. No. In any case, if the goods are not distinct in nature, there is no evaluation of any standalone prices. The concept of standalone prices applies only in step 2, not in step number 3. So indirectly, what he's saying, we don't need an assessment for the same. Okay, now watch this clarification chart. Answer the questions if you can. And if you're able to answer this, then I think your fundas are going very, very good. This is now a small little chart, which is going to give you a clarification in terms of things. Additional goods and services. And I am given the accounting which is going to apply. I said number 1, additional goods and services are not distinct. Any further questions asked, or is the accounting treatment decided? Additional goods and services are not distinct. Okay, it is a case, cumulative catch-up adjustment. The accounting is cumulative catch-up adjustment. The accounting treatment is purely cumulative catch-up adjustment. This is the only accounting possible if the goods are not distinct. The moment you see the goods are not distinct, it is a cumulative catch-up adjustment. Number 2, we are saying that they are distinct. And along with this, we are saying that the scope increases. The scope increases and the price also increases, and it is commensurate. And it is commensurate. So it is distinct. The scope went up. The price went up, and it is commensurate. So what do? Separate contract. We're going to treat it as a separate contract the moment we know it is distinct, and the moment we know that in this case scope and price is up. Let's go for the third combination. We are saying that the additional goods and services are distinct, and I say the scope went down. I'm not looking at any other thing. Scope went down. If the scope went down, then it is termination of the existing contract. Then it is considered to be a termination of the existing contract in this case. A failure of any of these conditions would mean a termination. Let's consider another fourth combination. Let's say the additional goods and services are distinct in nature, and we are saying the scope went up, and we are saying that the prices went up, but we are saying that the prices are not commensurate. We are saying that the prices are not commensurate. The scope went up, the price went up, but it's not commensurate. So what kind of accounting treatment would apply? It's again going to be considered as a termination of the existing contract. I think I've given you enough conceptual clarity on the various permutation combinations which could arise out of the three-step model. Okay, so let's, I think, begin with some practical questions with you at this stage. And let's get your comfort zones on the conceptual clarity so far. I don't expect a score of 10 out of 10 at this stage. I know it is technical, but I think anything around 7, 8 is pretty good. So let's get your comfort zones on the area of the three-step model we have done on the concept of contract modifications. And let's begin with the practical illustrations with you. Okay, I think Ramnath said, so if the scope increases but the price does not increase, then what will be the treatment? Well, you fall under this case that if the price, okay, you can take a fifth combination, price goes down, scope is up and the price goes down, then there's again a termination. So let's add on a fifth one, that you're saying that the goods are distinct in nature, and you are saying that the scope is up, and you are saying that the price is down, which indirectly means that it's not commensurate. So technically, if you ask me, this technically gets covered in the fourth one. What do you say? Okay, I think with it tells me it's 8.5. Koski tells me 10.10. That's brilliant indeed. I thought we were going to get some more comfort zones than all. As I said, digitally we are connected. So I think if we were physically connected, I would have actually looked into your facial expressions and got the inputs. But I think since we are digitally connected, only your chat tells me your comfort zones on that. So be very, be a little liberal in terms of giving yourself a score, in the sense, liberal in the sense, don't feel shy, don't feel what others are going to say. It's a learning process, and during a learning process, you should never feel inhibited what people think. Let people think what they think. You need to learn things in life. That's more important. Okay, Mukesh tells me 8. And Shriram, so if the scope is down but the price is up, the scope is down, any permit. Let me tell you one thing, friends. Let me tell you one thing. That if the scope is up and the price is increased and commensurate, it is separate. Any other case termination. Any other case termination. It is as simple as that. You create any kind of permutation combination. If the scope is up, the price is up, and it is commensurate, it is separate. You make any change in this combination, it's a termination. Let me put it like this. And Purnima said, break please, sir, can't we digest that? I need to do the questions, Purnima, right now. Let me first finish the question, then I give you a break. Otherwise, we'll break the flow. So let me, I think, say one thing. If you agree, say a yes. I'm giving you a consolidation of a standard sentence based on our discussion so far. Can I say, if the goods are not distinct, the accounting treatment is cumulative catch-up adjustment. If the goods are distinct and the two conditions are met, it is separate. All other cases, if the goods are distinct, it is termination. Agreed? If it is not distinct, cumulative catch-up adjustment. If it is distinct with the conditions met, it is separate. If it is distinct with the conditions not met, termination. Thank you. Right? Okay, we got score 9.5. And yes, true, wonderful indeed. Now let's come back to the questions with you. I'm going to solve the 3 questions which I took you earlier, so that my concept of modification gets over on that. Okay, so I think I'm just going to first clear this all, and so let me just come back to the questions on this. So let me just read this parts again. We're just going to solve these questions, and then we just apply the 3-step model out here. Okay, wonderful indeed. So I'm looking at question number 10, question number 11 and the question number 12. And Panu sir, it's interesting session. Thank you. Thank you so much, Panu. Okay, I think you got some score 8 by 10 as well. Great, wonderful indeed. Now let's take it further. Let's solve these three questions with you with a three-step model. We're going to solve this step by step. I need to contract this a bit so that it gets little space in writing. I can at least start writing on the left-hand side. I think it goes good. It says an entity promises to sell 120 products to the customer for 1,20,000. So we are given the inputs. We are given the inputs in this particular case that the contract is for 1,20,000. That's 1,000 per unit into 120 units. The products are transferred to the customer over 6 months, and the entity transfers the control of each product at a point in time. After the entity transferred the control of 60 units, the contract is modified to require the delivery of additional 30 units. And this is 150 identical products and to the customer at a price of 950, which is the standalone selling price. And then it says the additional 30 units were not included in the initial contract. Assume that the additional products are contracted at a price which reflects the standalone price. So let's apply the three-step model. Step number 1, is the goods distinct? We very clearly said, yes, they are distinct in nature. Reason? Identical products. If they're identical product, it means that these initial 120 units are capable of independent use. These additional 30 units are capable of independent use. We don't see any interdependency in this case. It is undoubtedly distinct. Now, when you say that, yes, they are distinct, we go to the step number 2 and we put across a question that did the scope increase? Number 2, did the price increase? And the price increase is commensurate to the standalone price or not? Did the scope increase additional 30 units? Yes, the scope went up. Is the price increase commensurate to the standalone price? Yes, the price is commensurate to the standalone price. What does this mean? That you are going to treat this as a separate contract altogether. That's all what you need to give to the examiner. You just need to give this input to the examiner that this is going to be treated as a separate contract. Done. Question number 10 is done. This is a question from the study material. Now let's have a look at question number 11, which is in the MTP April 21, and it's also in the education material as well. It says entity A enters into a 3-year service contract with the customer for 4,50,000, which is 1,50,000 per annum. The standalone prices of 1 year of service at that time is 1,50,000. A accounts for the contract as a series of distinct services. So the first question is answered that yes, the additional goods and services are distinct. At the beginning of the 3rd year, the parties agreed to modify the contract as under. The fee for the 3rd year is reduced to 120, and the fees for another 3 years is 3 lakh, 1 lakh per annum, and the standalone prices for 1 year service at the modification date is 120. So let's begin the journey. Step number 1, is the goods distinct in nature? Yes, very clearly given. Yes, they are distinct. We go to the step number 2. Did the scope increase in this case, and did the price increase commensurate to the standalone price? The scope went up because we extended the contract for another years. The scope increased because we extended the contract for further number of years, but the price increase is not commensurate to the standalone price. The scope went up, but the price increase is not commensurate. The price at that time is 120, but we increased the price by 1 lakh per annum. So the price is not commensurate. So what kind of accounting treatment would apply? We are going to treat this as if it is a termination of the existing contract, but we cannot stop here. Now I need to give the accounting treatment for a termination, and I said it's a prospective accounting. Now what is a prospective accounting? Let's have a look out here. So when you say it's a termination, that means the existing contract comes to an end. Now you need to see what is the consideration left over. Watch this carefully. Your earlier consideration was 4,50,000, 1,50,000 for a period of 3 years. 2 years, the work is already done. Third year is left over. They've changed the consideration of the third year to 1,20,000. This is the remaining consideration of the existing contract. Watch it carefully. This is the remaining consideration of the existing contract. Now, on the remaining consideration, what is the additional consideration? The additional consideration is 3 lakhs. So what do you need to do? You need to consider the remaining consideration of the existing contract and add the additional contract and spread it over the total period. Now, what is the total period? 1 year is left out of the existing contract and another 3 years is added on the new contract. So this is going to be spread over a period of 4 years on a straight line basis. So the amount of revenue which you will recognize each year is going to be 4,20,000 divided by 4. It comes to 1,05,000 per annum. I repeat, when you consider the case of what we call a prospective accounting, that means you're saying that it's a termination. What do you need to do? You need to consider the remaining consideration of the existing contract plus the additional consideration. Remaining consideration of the existing contract, which is not yet taken as revenue. You're going to consider the remaining consideration, which is not yet considered as revenue, plus the additional consideration spread over whatever is the remaining life of the contract. 1 year out of the existing contract is left over, and another 3 years have been added, spread it over a period of 4 years. Now, prospectively, the revenue recognition is going to become 1,05,000 per annum. Okay, that is question 11. Now let's come to the question number 12. Beautiful question. It says G enters into an arrangement with the customer. Let me see if there is any question coming in, because I think this was a little technical. Yes, I think it seems to be going good. Now, the last one is a little technical. Watch this carefully. G enters into an arrangement with the customer for infrastructure outsourcing deal. The moment it is infrastructure, it tells me the goods are not distinct. Based on the experience, G determines that customizing the infrastructure will take around 200 hours at the rate of 150 per hour. So earlier, we had an estimation that the consideration is 200 hours at the rate of 150. After incurring 100 hours, G and the customers agreed to change the aspect, and they estimate that another 50 hours of labor will be required at the rate of 100 rupees per hour. How would you treat this? Now, you need to watch this carefully, how a cumulative catch-up adjustment applies. Watch this. How do we apply the concept of a cumulative catch-up adjustment? Let's have a look out here. So we are looking at the concept of cumulative catch-up adjustment. I want to show you the detailed working. So let's have a look at the cumulative catch-up adjustment, which involves retrospective computation and a prospective accounting. Now see, what was the position earlier? The position earlier was that it was supposed to take 200 hours, and it was estimated that it would be 150 per hour. So that means 200 into 150, that works out at 30,000. So this was what was estimated earlier. Now, what is the position now? The position now is that it's going to take another, I guess, 100 hours. It's going to take another 50 hours at the rate of 100. So it's going to take additional 50 hours, and this is going to be at the rate of 100. So if I calculate this, this comes to a total of 5,000. So what we're doing, we are saying that due to modification, there is some additional hours at an extra rate. So what is the total consideration? It comes to 35,000. And this consideration is for a total of 250 hours. So let's indirectly get a weighted average rate. Let's indirectly get a weighted average rate. So you're saying that let me now revisit that if this estimate was known to me, if this estimate was known to me at the very inception when the contract was signed, then 35,000 would have been the total consideration for 250 hours. the weighted average rate would have been 140. This is retrospective computation. This is retrospective computation that you're saying if I knew at the very inception that the project will take 250 hours and the consideration I would receive as an entity is 35,000, 140 is the rate at which the revenue recognition should have taken place. Now, the company has already performed a total of 100 hours of work. So see what is the revenue they've already recognized. So what is the revenue which is already recognized in the books? How much revenue have they already recognized in the books? They've recognized a revenue on 100 hours at the rate of 150 because earlier the rate was 150. They've taken a revenue of 15,000 already in the books. If they knew that this is the rate, if they would have done this modification earlier, they should have taken what? So revenue which should have been taken. Revenue which should have been taken. So revenue which should have been taken. So we are trying to do a calculation that if we knew this earlier, we would have taken 100 hours at the rate of 140. We would have taken a revenue to the extent of 14,000. Indirectly, we are saying that we have booked excess revenue in the past because we recognized a revenue at the rate of 150, but we should have taken a revenue at the rate of 140. So they've taken extra revenue. So this extra revenue of 1,000, the extra revenue you have taken, this is going to be recorded in the year of modification. So we will record this decrease. We will record this decrease in the year in which modification took place. So this is called a cumulative catch-up adjustment. Make the calculations retrospectively. If you knew that this modification would have taken place since the very inception, we would have said that we should recognize revenue at the rate of 140 and not 150. The company has already booked a revenue considering that they followed a percentage completion method and they've done 100 hours of work. So they've already recognized a revenue at the rate of 150, which is 15,000. But if I would have applied a retrospective computation, they would have taken a revenue of 1,000. I'm not going to go back to the previous year records and rectify that. No, I'm not going to make any changes to the previous year records. We've done the calculations with a retrospective computation, but we will consider this on a prospective basis. So this decrease of revenue is going to be recorded in the year in which the modification takes place. This is called the concept of a cumulative catch-up adjustment. Compute retro, but account it prospective. Account it in the year in which the modification takes place. Right, friends? I guess I am pretty clear with this so far, so good. So let me see if any questions coming to your mind so far. Okay, so I guess I'm pretty clear, friends, till this stage. I think your mind must be quite tired indeed because we spent almost like 1.5 hours on the technical concept called modification. But I think once you're going to revise this and go through the concept and the 3 questions I've done, I think you're going to certainly come out very confident on this area. But before we go on to the next area of technical discussions with you, I think it's time to give you a small little break so that we can discuss my step number 2 in detail with you, which is again slightly technical, but it's very interesting indeed. So let's see if there is any questions at your end. Otherwise, we'll break for now. Crystal clear, Shriram. Wonderful indeed. Super. Right, friends. So I think it's almost 8:38. Just give us 10-12 minutes. So I think maximum by 8:50, I should be back. See you after the break, friends. Welcome back, friends. I think there is a small question before we proceed further. Manav, you said, so what happens to 1000 in the year of modification? Is my question reaching you? Yes. Yesterday, also after break, my messages couldn't reach you. I think there was some technical issue because I didn't get a couple of questions, I think, yesterday after in the last 15-20 minutes. So maybe there was some technical issue. But today, yes, I'm getting a question. So he said, what happens to 1000 in the year of modification? So what we're going to basically do in this case, we're going to record this decrease in revenue as a part of the revenue in the year of modification. So let's say the modification is done in the year, let's say 21-22. So what we're going to do as a part of the revenue in 21-22, we're going to record this decrease also and give a disclosure in the notes to accounts that the revenue for the current year 21-22 includes something which is on account of a cumulative catch-up adjustment. Right? I guess that answers your question, Manav. Okay, now I think let's take it further. So we will now go to the next area of discussion with you. My step number 1 is done. I am done with the concept of step number 1 along with the concept of 2 special issue. One is a combination of contract and one is the concept of what we call modifications. Now I'm going to go to the step number 2, which I said is slightly technical. So I know your mind must be quite tired with the concept of modification, but I need to modify your mind and I need to now take you to the step number 2, performance obligations. Let's first give you a thought process as far as the step number 2 is concerned. Then I'll create the chain of thought. So let me first of all begin with the inputs on the step number 2, that is identifying the performance obligation. So we are now working on the step number 2, that is the concept of identifying. The step number 2 is identifying what we call the performance obligations. Now let me first explain the thought process to you before we get into the technical details. So the next almost like half an hour is going to be a bit heavy. But just bear me, if you're able to get this next half an hour, you're going to get a good idea on the step number 2. Now, basically, what is the concept behind step number 2 is that companies are selling bundle. Companies are selling bundle of goods and services. The companies are basically selling, you can say, bundles of goods and services, and there is a need, what we say, to unbundle them. There is a need to unbundle them. Now, why is there a need to unbundle them? Let's say, for example, if you remember last session yesterday, I gave you an example that the company sold a machine, a laptop, and along with the laptop, they also gave a 3 years AMC as well. Now, in this particular case, what the company is doing, they are selling a bundle of goods and services. But the control of these goods and services may not be transferred to the customer at the same point of time. Mind the words carefully. You know, when you are transferring a bundle of goods and services, it is not necessary that the control of the laptop and the AMC services is given to the customer at the same point of time. They may be transferred at different points in time as well. Therefore, there is a need to segregate this bundle and segregate what is the unbundle so that you can recognize a revenue at different points in time. The revenue recognition for a laptop, for example, can take place when the laptop was sold. The AMC charges can be taken as revenue when the AMC services are provided. So the step number 2 is basically when a company is selling a bundle of goods and service, especially if you notice in the telecommunication sector, especially if you notice in a construction sector, in real estate sector, the companies are generally selling bundles of goods and services. As a mobile service provider, you give them a calling facility, you give them an internet facility, and maybe certain other value-added services put together as a bundle. So there is a need to understand that we unbundle them. Now, for this purpose, I would say the best thing is that when you read a question, the first thing is that you make a list of promises. I would say this is the first thing you can do in a question. Just read a question and identify the various promises. As I said yesterday, now what do you need to do? Let's say there are a total of 3 promises when you read a question. You made a list that, okay, these are the three promises which are very visibly clear in the contract. Now, in step number two, what you need to do, you need to identify that is each promise a performance obligation or not. Now, hear me very carefully, friends. In step number two, you need to identify whether each promise is a performance obligation or not. Each promise, let me write down, each promise will be a performance obligation provided it will be a performance obligation provided it is distinct. We just heard this word a little while back when we were discussing the concept of modification. So every promise will become a performance obligation provided you are able to prove that every promise is distinct in nature. Got it? So the idea in step number two is that you need to evaluate, is the promise a performance obligation? How do we do that? We'll learn. But we're just looking at the concept. What you need to do in step number two, you need to basically evaluate that is a given promise a performance obligation or not. So the standard Ind AS 115 tells me that when you evaluate that a given promise is supposed to be a performance obligation, you need to basically evaluate that if it is distinct, yes, it is a performance obligation. So the possibilities which could arise is you identify that yes, every promise is distinct. You identify that every promise is distinct. Therefore, every promise is a performance obligation. You identify that none of the promises are distinct. If none of the promises are distinct, all of them will be grouped as a one performance obligation. Now, what are the parameters of deciding distinct or not? We're going to understand this in step number two, but mind the words carefully. The step number two is deciding that is the promise a performance obligation. And a promise becomes a performance obligation if it is distinct. So if somebody asks you, what is the difference between a promise and a performance obligation, or what does it connect? You can say if the promise is distinct, it is a performance obligation. If the promise is not distinct, it is not a performance obligation. Then the person will ask you, how do you decide that it is distinct or not? That we learn. There is also another possibility that, two promises put together is considered as one performance obligation, and one promise becomes another performance obligation, so they become two. So the exercise which you're going to do in step number two is when you read a question, you need to first of all identify what are the various promises which an entity made to the customer. List down the list of those promises. Sometimes there might be numerous number of promises and it may not be possible for me to make a list. But then most of the questions which you will see from the examination point of view, the list will be very clear. You will read the question and you'll be able to identify, okay, this is promise one, promise two, promise three. And then I will start evaluating that is this promise a performance obligation? If it is distinct, it is a performance obligation. If it is not distinct, then it's not a performance obligation. One. Now, let's go on to the next agenda. As I said, in terms of step number two, there is a para number 27, which is a key important paragraph. And this para indirectly tells you how to evaluate whether a promise is a performance obligation or not. So we're going to read this para number 27. You need not remember the para number. This is only because, I feel a little more comfortable explaining things. So we're going to see this crucial para number 27. What does it state? Now, let me read that para number 27 with you. So I've just taken a little extract of this para number 27. So which I'm going to elaborate to you, and let's have a look. So let's have a look on this para number 27. So I'm looking in terms of the para number 27. Watch this carefully. Read this very carefully with me. Let me see if there is any questions coming in the meantime with you. Okay, Namrata, you said distinct promise means, are we just coming to that? We're just coming to that. How do you define that it is distinct in nature? Let me just zoom it a little further. Well, I think that makes sense. I think it should be visibly very clear, I guess. Let me now read some things with you, friends. Now, please hear this very carefully, very, very carefully. I need 100% attention of yours. I know it is technical, But then, you get a good grip on things only when you get a good conceptual clarity. So once you're going to hear it properly, revise it properly, you're going to get a good clarity of thoughts. Okay. As I've already said, it's a very important standard from the examination point of view. The weightage as far as this particular standard in the exam is concerned easily ranges on an average of 8 to 12 marks in the exam. You can be pretty sure of getting almost like 10 marks question in the exam on this particular standard. And 10 marks means quite a bit. Out of 100 marks, almost like a 10% weightage on the standard. Now, let me just read the panel number 27. It says, a good or service, that means a promise. A good or service that is promised to a customer is distinct if both the conditions are met. Panel number 27 tells me that you will consider a promise to be distinct. That means a performance obligation. I repeat, you would consider a promise to be distinct. That means a separate performance obligation if the two conditions are met. It says the customer can benefit from the goods or services either on its own or together with other resources readily available to the customer. Some technical language, he says that the customer can benefit from the goods or service. Then he says the entity's promise to transfer the goods or services is separately identifiable. All I understood is that panel number 27A is telling me that the customer can benefit from the goods independently. And all I understood in panel number 27B is that the promise of the entity is separately identifiable, but we did not technically understand what is this. Now, let's not get into what is the language of 27A and B, but let me tell you one thing. Let's give you a chain of thought. You need to meet 27A and you need to meet 27B. If this is met and this is met, the promise is distinct. If this is met and 27B fails, it is not distinct. If 27A fails, there is no need to evaluate 27B. It is not distinct. So we need to get the chain very clear. You need to meet 27A and you need to meet 27B. If both are yes, distinct, one is a no, is not distinct. You know what now these standard setters did? They did something very interesting. In order to help you, the interpretation of 27B, in order to help you, the interpretation of para number 27B, they gave a clarification in para number 29. So they gave us a para number 29 which elaborates 27B. It doesn't elaborate 27A. The para number 29 elaborates the para number 27B. Now see what is given in para number 29. I'm just going to take you back to the para number 29 and just have a little look at this particular para number. So let's have a little look at the para number 29. So let me just clear this bit. First again, and let's read what is stated in terms of para number 29. There is a para number 29 A, B, C. I'm not reading it entirely. I'm just reading the para number 29. Now let's get the thought clear. It says out here, I'm just reading in between, factors that indicate that two or more promises are not separately identifiable. Para number 27B was saying that it should be separately identifiable. Hear me clearly. Para number 27B was telling me that it should be separately identifiable. Para number 29 is telling me that these are the examples when it is not separately identifiable. Now let me ask you a simple question. If you meet para number 29, does this mean that para number 27B fails? Tell me yes or no. Para number 27B says that it should be separately identifiable. And para number 29 says, let me give you examples when it is not separately identifiable. Does this mean that if you pass 29, you indirectly fail 27B? What is your insights on that? Very true. So I need to be very clear that when I am going with the understanding that if I need to evaluate para number 27A, I'll tell you how to evaluate. But if you need to identify 27B, I'll look at 29. If you pass 29, you fail 27B. If you fail 29, you pass 27B. Wow, beautiful. Okay, so I think let's come back to the journey and let's have a look at the para number 27. I'm just going to come back on the concept of para number 27, friends, with you and give you some little technical insights now. We are not interested in exactly reading the entire inputs with you, but I think to get the clarity of thought, I'm just doing that. This is all given in the study material. Even if you look at the step 2, the inputs on this is very clearly given. Let's have a look now. It says a good or service that is promised to a customer is distinct if both the conditions are met. Now, let me, I think, first give you an insight on the para number 27A and B. You know, there is one thing which the standard took into account. You need to consider situations from two angles. One is you need to apply the angle of the entity. Para number 27A looks at from the entity's point of view. Para number 27A looks at from the entity's perspective. And para number 27B looks at from the customer's perspective. Though if you read the language of 27A, the word used is customer. And if you look at the word para number 27B, the word used is entity, and many people tend to get confused. They look at the word customer and they say, sir, you are teaching us wrong. No, friends, I'm not teaching you wrong. I am giving you exactly the 100% correct concept. I am completely in my senses. I'm completely in my senses. So when you look at para number 27A, you are looking at things from the entity's point of view. I'm going to put across a question to the entity and then evaluate. When I'm looking at para number 27B, I look at from the customer's point of view. Now, let's see what is given in 27A. The customer can benefit from the goods or services either on its own or with other resources that are readily available to the customer. Let's take a very simple example. There is an entity, which is doing a couple of things for customer. They tell the customer, you want a whitewashing? We do it. You want an electrical fitting in the house? We do it. You want to just go in for flooring services? We do it. They are providing independent services to the clients. They're providing just whitewashing of the house. They're providing electrical fittings. They are providing services on floor fitting, etc. Everything is being done independently. They say we provide goods and services independently. Somebody says, do you provide everything together? If I want you to make a complete house as a package deal, do you do that? I said, yes. I am selling goods individually and collectively. Mind the words. I'm selling goods as a bundle that is collective. I'm also selling the goods on an unbundled manner. As an entity, I have a market where I have customers to whom I sell goods individually. Let's take another example. Let's say, for instance, my company is selling product A, B, and C. I have a customer base who wants only A. I have a customer base who wants only B. I have a customer base who wants only C. I have a customer base who wants A plus B. I have a customer base who wants B and C. I've got a customer base who wants A plus C. I've got a customer base who wants A plus B plus C. I'm selling every kind of product. I sell them individually. I sell them as a bundle. Whosoever customer approaches me, I sell under my umbrella everything. So I'm going to first of all approach the entity and ask them, do you regularly, please hear the words carefully, I'm going to ask them a question. I will say, do you regularly sell each of these goods and services to other customers independently? If they say a yes, that means the customers can obtain a benefit out of each and every good and service. Even the customer who approached me for A plus B plus C, if I gave him A, he doesn't have to wait for B and C. Because he approached me to buy ABC as a bundle, but I have customers who take only A. They don't buy B and C from me. They might be buying it from outside. So the customer can use it on its own. Maybe the customer already had B and C with him, or it is readily available in the market. Every entity is selling ABC independently, separately. So which means that you need to first of all evaluate from the entity's point of view that if I am approached as an entity and they say that you've entered into a contract where you're selling A plus B plus C to a customer, they will put across a question to me that do you sell A, B, C separately as well on a regular basis? I say yes. I sell regularly ABC separately. This customer contracted, to buy ABC as a bundle. So I said, okay. But I am selling A also and B and C separately to other set of customers as well, which means from the entity's point of view, each and every good is distinct. There is no interconnection because if I supply A, the customer doesn't need to wait for B and C. He can either buy it from me or buy it from outside, or maybe he already has B and C. The presence of a market for each and every product independently on a regular basis triggers the aspect that yes, from the entity's point of view, every good and service in the bundle is distinct in nature. Did you get the input so far, friends? Did you get this concept that when I'm looking at 27A, you're looking at from the entity's perspective. You're looking at can the customer obtain a benefit if I transfer only one good or service out of the bundle? If as an entity, I am regularly selling each and every good and service, I can certainly prove that yes, the customer can obtain benefit of these goods on an individual basis. So from an entity's point of view, every good and every service in the bundle is supposed to be distinct. Therefore, it becomes a performance obligation. Great, super. Now let's take it further. Now let's go to the step number 27B. You looked at the entity's point of view and they're saying, yes, it is distinct. Now you need to see the other side of the coin as well. You now need to approach the customer as well. And the clause number B is looking at things from the customer's point of view. In simple words, what you need to look at the clause number B is what the customer wants. You need to put across a question what the customer wants. What does he want? What is his want is agreed. The entity says that we sell goods independently to various kind of customers, but please look at the customer's perception as well. The customer says, boss, I came to your shop to buy all the things, three things put together as a bundle. Your obligations are not discharged until you provide all the three to me. Sorry, boss, you can't recognize your revenue because you need to see my perspective. After all, customer is the king. Now, it would not be wrong to say that Ind AS 1115 actually takes a note of the fact that customer is technically supposed to be a king. Because what a customer wants is going to be the deciding factor. Even if the entity says that, yes, every good and service is distinct, it doesn't help. You need to look at from the customer's point of view, what does he want? So we'll go to the para number 29 to evaluate that if a customer wants what is written in 29, please hear the words carefully. If the customer, we go to para number 29, if we know that the customer wants what is written in 29, 27B fails. So if you're able to say that this is what the customer wants, then 27B fails, then it is not distinct. Now, let's have a look now in terms of what is the para number 29. So there are three inputs which are given in terms of para number 29, ABC. Let me tell you, the inputs which are given in terms of para number 29 is illustrative in nature. It is not exhaustive in nature. The inputs which are given in terms of para number 29 is purely illustrative in nature. It is not exhaustive in nature. Let's have a look. It says not separately identifiable and they are not limited to the following. From the examination point of view, I would say para number 29 is more or less exhaustive for me because from a practical life point of view, it can be a real challenging task. But from an examination point of view, I would consider that let me concentrate on para number 29. If you see that the parameter 29 is getting met, it means that the goods and services from the customer's point of view is not distinct in nature. Now let's see what is given. The entity provides a significant service of integrating goods and services. Let's take an example. There is a company which is a contractor. There is a reporting entity which is a contractor. Their business is to construct house. So they are constructing ready-made apartments for the customer. They provide electrical fittings separately. They provide the furniture fittings separately. They provide, let's say, whitewashing separately, electrical fittings, floor services. Everything is being provided independently and as a bundle. The customer approaches this entity and he says, I want a ready-made house, friends. The customer approaches the entity and he says, I want a house. Let me ask you a question. Do you think this entity will have to integrate every good and service into one complete house that is the output? Are they going to integrate everything, construct, paint, flooring, electrical fittings, everything? Is the entity going to provide a significant services of integrating the goods and service? What did the customer want? He says, boss, I came to your company because I want you to integrate everything into one complete house for me. What do I want? Don't see what you can do. You might be providing independent services to various peoples, but what I want in life is that you integrate every good and services into one complete output that is a house. So if the customer wants a significant integration, if the entity has to provide a significant integrating services, now you would say, what does significant integration mean? The standard is not giving you a definition of what is significant in nature. But when you're looking at the concept that you want a significant integration means huge amount of integration is required. You need to apply a judgment, like in terms of house, you need to significantly integrate everything into one complete output. If the customer wants a significant integration, all the promises will be clubbed as one performance obligation. Am I clear with the example? Don't worry, the notes would come to you later. No worries on the note, friends. I'll be giving you the notes later. Great, got it, wonderful. Now let's take it further. Then there is another clause which is given out here. Then there is a clause number B which says one or more of the goods and services significantly modifies. It significantly modifies or are significantly modified by one or more of the other goods and services. Let me explain. What does this significant modification mean? Let's say a company is providing, let's say, a software, and it provides updates as well. A company provides a software and it provides updates as well. There are many customers in India, who would take a software but would refuse to pay for updates. He says, no. If you're wanting extra money for the updates, I don't want updates. I'll manage without the updates. Nobody wants to pay extra money if you're not interested in using those extra features of the software. So in this particular case, the company is providing a software. So they've got a customer base. Somebody buys just a software. Somebody buys a software with an update. Now, there is a customer which approaches this entity. Please hear the facts carefully. There is a particular customer which approaches this entity and he says, I want a software. And the company tells me, do you want the updates? And the customer says, okay, is this updates important? The entity tells him that without the updates, the performance of the software is going to be very bad. If you're not going to take the updates, your work will get heavily impacted. Let me ask you, what do you think the customer would want? Would he want the software without the updates, or do you think he wanted with updates? If you are a customer and somebody tells you that, do you want the updates? And he tells you the crucial effect of those updates. He says, if you don't take those updates, then the performance of the software is not going to fulfill your needs. Updates are very crucial to your things. You won't be able to get the real advantage of the software. So as a customer, what do you think? You would want the updates or not? So you would want the updates in that particular case. If the entity tells you that without the updates, the software is not going to function the way it can, you will not be able to get the real benefit out of the updates, then what do you say? Are you wanting those updates or not? I think I didn't get any answer so far, but I think the answer, of course, logically would be yes. The customer knows that the performance of the software will get badly impacted if he doesn't go for the updates. Now, let's get this. I think we got the answer, yes, with the updates. So what does it say? Is the updates, which is the second promise, hear this carefully, is the updates, which is the second promise, modifying the software significantly? Yes, it is. We can say one or more goods or service, the update significantly modifies the, you can say, software. So if I know that the reporting entity will provide me a second good or a second service, and it will modify the first good or service significantly. Once he provides me the second good or the second service, it will significantly modify the first good or service. That means then in this particular case, the goods are not distinct in nature. We will club the promises and treat it as a single performance obligation. Okay, let's have a look at the other one now. Let's have a look at the third example. There are only 3 examples which are given in para number 29. It says the goods or services are highly interrelated, interdependent, highly interrelated or highly interdependent. They are highly interdependent and highly interrelated. So if the goods and services within the bundle are interrelated, interdependent, highly, you can see the word significant, significant, highly. If they're highly interdependent and highly interrelated, then in this particular case, we are going to treat them as a single PO. So an example, let's take an example further on this as well. There is a company which is manufacturing certain tools. They create a design for the customer. They manufacture the tool as per the design. I've got a customer base who just gets a design made. I've got a customer who comes already with the design and tells me to manufacture. I've got a customer who tells me that I want you to make a design and manufacture both. So I've got all varieties of customers with me. A customer who approaches me that I just want the design. A customer who comes with the design and tells me to manufacture. There's another customer who says, I want you to design it and then manufacture as per the design. Which means, as per para number 27A, from the entity's point of view, I've got different varieties of customer. So I can say that if I provide a design, he can benefit out of it. If I provide just the manufacture, he can benefit out of it. So from the entity's point of view, every promise is distinct in nature. Now let's look at the customer. A particular customer approaches the entity. A particular customer approaches the entity and tells the entity, I want you to make the design and I want that everything is manufactured as per the design. I am not willing to accept any compromise on quality, because if somebody else makes a design and somebody else makes a manufacture, it's going to be dangerous for me in life. He says, I want you to make the design. I want you to manufacture the tool as per the design. Do you think that designing and the manufacture are highly interrelated and interdependent in nature? Yes, it is. So what does the customer want? He is wanting that you integrate. Trust me, in a given example, it is not necessary that any one of 29 is going to be met. In a given circumstance, you can say even 29A is getting met, even 29C is getting met. But if para number 29 is met, then para number 20C and 7B is definitely a failure, which means that you're going to treat all the promises as a single performance obligation. Right, friends? I hope I am clear. So can you please consolidate all these inputs once again and elaborate the inputs? Yes, I'll do that. Let me, consolidate the entire inputs to you. Then we'll do some case studies. We'll document the notes also to you. Step number 2 can be very, very crucial in a practical life kind of situations, because there could be a lot of challenges in terms of identifying the performance obligation. Let me come back to the thought process, and let me just come back and document some notes to you on the process of the step number 2, that is identifying a performance obligation. So let's get the chain very clear, and then we will do some questions with you on this area. So I am working on my notes in step number 2. So in step number 2, we need to identify the performance obligation. So this is the focus in terms of step number 2, identify the performance obligation. We can technically say it is unbundling. It is technically called unbundling. We are trying to unbundle the bundled goods and services. So I would say this has got a 2-step model. Step number A. And there is a step number B. So it's a 2-step process which you need to apply. Because we're looking at 27A, we're looking at 27B along with 29. So in terms of step number A, whose point of view am I going to evaluate? So you are going to evaluate from the point of view of the entity. You're going to evaluate from the point of view of the entity. And in step B, whose point of view are you going to evaluate? You're going to evaluate from the customer's point of view. You're going to evaluate from the customer's point of view. So this is important, that whose point of view are you going to evaluate? This is one focus point. So there is a question which I'm going to put across to myself. There is a question which I'm going to put across to myself when I'm looking at step A. And the question is the entity regularly, let me underline the word regularly, is the entity regularly selling each and every good and service in the bundle separately? Is it selling each and every good in the bundle separately? So you're going to put across this question to yourself, that is the entity regularly selling each and every good and service separately? I need to basically prove that I have a market for the bundle. I have a market for the unbundled goods. I repeat, you need to basically prove in this particular case that as an entity, I have a market for a bundle. I have a market for the unbundled goods and services as well. Okay, if the answer to the question is yes, you go to step number B. If the answer is a yes, you need to go to the step number B. And if the answer to this question is a no, do you think I would go to step B? No. Because unless you meet step A and B both, it cannot be distinct. So if you fail the step number A itself, it is not distinct. Then in this case, we will say that it is not distinct in nature. So we will indirectly treat this as one performance obligation. The promises will be clubbed together and treated as a single performance obligation. The promises are going to be clubbed together and treated as a single performance obligation. Okay. So this is the step number A, which I've given you, that you need to look at things. You need to look at things in terms of the entity's perspective. You're going to see from the entity's point of view and ask a question, is the entity selling on a regular basis goods and services separately? If yes, you go to step B. If no, then it is a single performance obligation. Let's take it further. Now, in terms of step number B, the question you're going to ask yourself is, what does the customer want? So we're going to put across a question, what does the customer want? So what does the customer want? So underline the word want. What does he want is the important agenda. What does he want? Now, there is a possibility that he wants significant integration. There is a possibility that he wants a significant integration. So there is one possibility that he wants a significant integration. That is one. There is a second possibility that he knows that it will significantly modify. He knows that it will significantly modify once the second good and services are received. Once the second goods and services are received, it will modify the first goods and services. He knows that it will significantly modify, or there is a third possibility that the goods and services are highly interrelated and interdependent. They are either highly interrelated or they're highly interdependent in nature. So they're highly interrelated or highly interdependent in nature. You need to see, does the customer need a significant integration from the entity? Does he know that once the second goods and services are provided, it will modify the existing goods and services? He knows that the second goods and services is interrelated to the first goods and services. So if the answer to these questions, is a yes, or the answer to these questions is a no. So if the answer to the question is a yes, you need to say it is not distinct. So if the answer is a yes, they are not distinct in nature. They are not distinct in nature. We're going to treat them as one performance obligation. We're going to group all the promises put together and treat it as a single performance obligation. But if the answer is a no, then we will treat this that each promise is a separate performance obligation, and we're going to get multiple performance obligations. Let me just quickly recap all this and then take you to some practical illustrations on this. So it's a simple two-step model. It's a simple two-step model. The step number 2 comprises of a simple two-step model. Now, what do I need to put across to myself? Number 8, look at from the entity's perspective. You need to look at from the entity's perspective and see, is the entity on a regular basis separately selling every good and service in the bundle or not? Now you would say, sir, let's say if there are 3 items A, B, C, and the company is selling A separately, but not B and C separately. Let's not get into those complications at this stage. As I said, it can be a complicated affair. But for the time being, let's consider that he is selling A, because if company is not selling B and C separately, then in any case, B and C will be treated as one PO. That one thing is very clear. So if you say that the company is providing a bundle of A plus B plus C, and you say that the company regularly sells A separately, but doesn't sell B or C separately, so they are selling A separately and B and C separately, thing is finished. Even from the entity's point of view, you can treat A as a single PO, you can treat B and C combined as a single PO. B and C cannot become 2 separate POs in that case, because the very first step fails. The entity is not regularly separately selling those particular products. So you need to focus on the entity's perspective, that do they sell things individually, separately or not, on a regular basis. They're separately selling it is one, and regularly selling it on a separate basis. It's not that one time they made a sale. It's not that, there was a one standalone sale which was made on a separate basis. They should be engaged on a regular basis, making independent sales of each item separately. If that be the case, every promise is a performance obligation. If that is not the case, then you club every promises and is treated as a single performance obligation. Then you look at the customer's perspective and look at what he wants. So if you notice any significant integrations, if you notice any significant modifications, if you notice any highly interdependence, interrelationship, then in those particular cases, we will say that there is a single PO. And if the customer doesn't want any one of these, then every promise becomes a separate performance obligations, and you're going to get multiple performance obligations. I hope, friends, I am clear with the conceptual bit. Let me just see if there are any questions coming to your mind. Okay, I think Vikram has got a question. Do I need to apply all the conditions in step B questions? Well, technically, yes, you need to go through the entire inputs, evaluate the questions carefully and see if any one is getting met. Because even if any one is getting met, then in that particular case, it will be a single PO. And technically speaking, from the examination point of view, you need to fail all these 3. You need to fail all these 3 in order to say that, yes, every promise is supposed to be a separate performance obligation, right? So far, so good, friends. Are we comfortable with the concept? Let's get your quick scores on a scale of 10. What's your comfort zone on the conceptual understanding? And then in the meantime, let me take you to some practical illustrations on this scale. So this is as far as the step number 2 is concerned. So let's, I think, have a look at a question. So we've got around 4 questions with me at this stage, which I'm going to cover up in this particular step with you. So after the questions, you're going to get a good clarity of thought. So what's your comfort zone, friends, on a scale of 10 at this stage? I know it may not be very good, but I think I'm looking something around 7, 8 is pretty good to go with. Okay, so let's, I think, zoom this to begin with. So your comfort zones are necessary because conceptually, I know without taking examples, it's sometimes very difficult to visualize things. I fully agree with that. But at the same time, conceptually, we need to be very clear on things. I think we got one input so far with it is 8. And what about my other friends? You refrain from giving your self-assessments. When you're going to go in a practical life area, your employers is going to ask you to do a self-assessment before he gives you an assessment on things. So in any case, you got to get into the habit of making a self-assessment as well. It's very easy for us to, evaluate others in terms of what the other is good or bad. It's very difficult for us to evaluate ourselves. The real pleasure lies in evaluating yourself. It's very easy to judge others. We are in an era where, we are all in the process of judging others. We are always judging others in terms of things, but it's very difficult to judge yourself in terms of what you've learned. So it's important in a life, trust me, I'm saying it otherwise, that it's important in the life that, you learn the art of judging yourself, because it's very easy to judge others. We don't want to be a part of the crowd where we judge others and we're always judgmental in terms of things. We need to get in the habit of improving ourselves. We don't need to improve others. We need to improve ourselves. Okay, so we got another input, 7.5. That's great. Let's now take it further. So I am now going to take you to a few questions on this. Let's have a read. Let's go to the question number 13. This is one of the questions in education material. In fact, I've taken 3 questions from the education material. Similar kind of questions are given in the study material as well, but I've selected some very good questions so that the conceptual clarity gets clear. Let's have a read. I'll be sharing these questions with you, no worry. It says N Limited. So we are given N Limited enters into a contract to build a house for a customer. N is responsible for the overall management of the project and identifies various goods and services that are provided, including the architecture design, the site preparation, the construction of the house, the plumbing, the electrical services, and the fresh carpentry. So a couple of promises he has made to the customer in terms of things. N regularly enters into such contract with customers to sell these goods and services individually to them. Regularly enters to sell them individually. I don't think so. I need to say something. Let me ask a few questions to you as I proceed. So my question, friends, to you, do you think step number A is met? Think about this very carefully. I am given, if I start looking from the entity's point of view, N is regularly entering into contracts to sell the goods and services individually. He's got a customer base where he sells goods individually. He sells them as a bundle. So if I apply my step number A and look at from the entity's point of view, can I say the answer is a yes? Undoubtedly, the answer is a yes. So in this particular case, the entity is regularly and separately selling these items individually, unbundled manner. So step number A is met. I go to the step number B. Let me put across the question, what does the customer want? N enters into a contract to build a house for a customer. What did the customer contract for? He says, boss, you are providing multiple goods and services. I want you to integrate them and build me a house. He says, I want you to integrate and build me a house, which means what? The customer is wanting a significant integration of various goods and services in this case. So let's get the inputs at your side. Are you going to treat every promise as a performance obligation or club all the promises as a single PO? From the entity's perspective, we said every promise is distinct. But from the customer's point of view, we said that 29 is passing, which means 27B is failing, which means significant integration required by the customer means that all the promises will be clubbed together as a single performance obligation. So we can say in terms of step 1B, it's a single performance obligation. So how many performance obligations are there in the contract? We'll say there is a single performance obligation in the contract, right? I didn't get many answers on that. I think many of you are quite tired or maybe left for office so far. But I think the answers would have been encouraging. I think it's a pretty simple question because if you look at the entity's perspective, the question is very clearly telling you that it is regularly, individually selling these items. And when you look at it from the customer's point of view, it's very clear that he's wanting a significant integration of all the goods and services into one house as a final output. So all the promises clubbed and put together as a single PO. Let's go to the next question, number 14. It says an entity P grants a customer a 3-year license to antivirus software, and it promises to provide the customers when and if available updates. So he is providing an antivirus software, and it says he promises to provide the customer with when and if available updates. I think apparently if somebody will ask me how many promises are there, I'm not saying performance obligation, I'm saying promises. I would say there are two promises. One is that you are providing a 3-year license for anti software. That is one promise. And I've darkened the word and. You're also promising to provide the updates as well. So now we need to understand, are these two promises treated as two performance obligations, or are we going to treat them as a single PO? I'll make a little variation after read the question. It says so that the software P Limited is frequently providing updates that are critical to the continued utility of the software. So the update seems to be very critical in nature, without which there will be a problem. Without the updates, the customer's ability to benefit from the software would decline significantly during a 3 years arrangement. Whether the antivirus software and the updates are distinct performance obligations or not. Now, I think let me make a walkthrough again on the step A and the step B. So if I look at the step number A, let me first of all look at the point. You know, if you technically see in this question, I don't think so. I am very clearly given in the question the data whether this entity is regularly selling with or without updates. But you can see something. It says P frequently provide updates. So he is providing updates frequently. But I'm sure he must be having two set of customers, one set of customers who might be looking for frequent updates and another set of customers who may not be bothered with the updates. Because there are every kind of customers. So I think it would be logical to presume that every customer is not willing to pay for the update, especially if the consideration increases. I'm not willing to pay an extra money because I feel that the updates may be critical, but my need of the software is not very, very extensive in nature. So if my need is not very extensive, I'm not interested in updates. So I think if you look at from the entity's point of view, I can certainly say that there are two things. The entity may be having two set of customers, one who wants the software with the updates, then there will be another set of customers who just wants the software without any updates. So I would say from the entity's point of view, yes, every performance, every promise can be treated as a performance obligation. Every promise can be treated as a performance obligation in this particular case. That can definitely be said in this case. Now let's come to the step number B in this particular case. Let's have a look at the step number B in this particular case. So when you're looking at the step number B in this particular case, look at what the customer wants. Now, considering that the customer is aware that the ability of the software will decline significantly, because these updates are critical. So we know that once the update is provided, it is going to significantly modify the software. The software, which is like you can say the good one, and then when you provide an update, it significantly modifies the software. So I would say in this case, there will be a significant modification would take place once the updates are provided. Since a significant modification would take place once the updates are provided, we will consider all the promises put together as a single performance obligation. So in this particular case as well, we can say it is going to be case of one performance obligation. Because para number 29 is getting met, and therefore we can say the para number 27B fails in this particular case. So the promises are going to be clubbed as one and called as a single performance obligation. Okay, so this is one input further, and that's rightly said with it, absolutely a single PO. Let's look at another question with you. So let's have a look at another question with you. Let's have a look at question number 15. It says in question number 15, company A is an auto component supplier and supplies auto parts to original equipment manufacturer. We call them as OEM. It has received a contract for making a tooling for a total consideration of 5 lakh. This tooling requires a design to be created and approved from the customer, and then the process of manufacture of the tooling will begin. So you need to first of all create a design, get it approved from the customer, and then the process of manufacture will begin. So designing and manufacture seems to be the two kind of promises made to the customer. This process is completed in a short period of time, around 1 month, whether the designing and the tooling are separate performance obligations or not. Now, in this particular case, it is very clear that the customer is wanting that you create a design, get it approved, and then the manufacture would take place, which means that there is a highly interrelationship, interdependency between the designing of the tool and the manufacture of the tool. But let's go through the step number A and B in this case. So let's go to the step number A, and let's look at from the entity's point of view, and then let's go to the step number B and look at from the customer's perspective as well. Here again, in this particular question, I am not very clearly given the inputs from the entity's perspective that do we have customers who might be wanting just the designing part, or there might be customers who might be wanting just the manufacturing part, or there may be customers wanting a designing and a manufacture both. I presume that unless mentioned otherwise, the entity may be having different set of customers. They may be having a customer base for which only designing is done. They may have a customer base for which just a manufacture is being done. So I think I can safely assume that they must be regularly providing a separate goods and services independently. So we can say yes, the step number A would undoubtedly yes. Unless mentioned very clearly, I think we can always presume that the step number A is always going to be a yes. Let's go to the step number B. Considering that the manufacturer is totally dependent upon the design, we can say in this case it is highly interdependent and interrelated, which means again, in this case, we are going to treat this as a single performance obligation. I know what you must be thinking. You must be thinking, so you've taken 3 questions, to give us a clear-cut application of para number 29. Yes. I wanted to give you the insight that once the para number 29 is met, so I've intentionally taken 3 cases with me. One is an example which proves me that there is a significant integration. One example which proves me that there will be a significant modification. And one example which proves me that there is going to be a highly interdependent between the two. So the moment the customer wants a significant integration, or there is a significant modification, or there is a highly interdependent interrelationship, in those particular cases, you need to club the promises and treat them as a single performance obligation. Right, friends, let me see if any questions coming to your mind so far. So are we all set with the clarity of thought? Then I think we can take one small little question now, which is going to be slightly technical, because this involves looking at a lot of promises and identifying that is the need to group the promises and treat a group of promises as one PO, or are we going to treat every promise as a single performance obligation? So are we all set? Are we clear, friends, till this stage? Any things coming to your mind? Are we clear? Just a message on your part would be good enough. Are we clearly understood, friends, on the step number 2, the concept of para number 27 AB and the concept of para number 29? Okay, I think so far so good. I think the messages since morning has been a couple of messages. I think the system may not be taking in some more messages at this stage. So I think I'm getting very slow messages at this stage. Anyway, so I think let's pick up another question with you. And if you can try answering this, do try this out. Otherwise, I am definitely going to answer this question to you. So let's take the journey. This is the last question of the day before we consolidate quickly the learnings for the day. Step number 1 is done and the step number 2 is done, and we don't have any complications, any special agendas relating to step number 2. So we'll be starting a journey on the step number 3, not today, but tomorrow. But before that, let's have a look at the question number 16. It says an entity, a software developer enters into a contract with a customer to transfer a software license. 1. Then he says perform an installation service. 2. And to provide an unspecified software updates. That is 3. And a technical support. That is 4. I think if we start counting the number of promises, I'm not saying performance obligation, I'm counting the number of promises he's entered into the contract. I can actually see a list of promises. He says, I'll transfer a software license, 1, installation service, that's 2, specified, unspecified software updates, 3, and a technical support online and telephone for a 2-year period. So there are a total of 4 promises in the contract. The entity is selling the license, the installation service, and the technical support services separately. So they are already selling these items regularly and separately, which means if I look at the concept of step number A from the entity's perspective, I think that is getting met because they are separately providing all these services, the license, the installation, the technical support. And of course, the is not said anything about the software updates, but I think that software update is again going to be independent. He says the installation service includes changing the web screen for each type of user. For example, marketing, inventory management, and information technology. So the installation all depends upon what kind of use the customer is doing. The installation service is routinely performed by other entity and it does not significantly modify the software. The software remains functional without any updates as well, and the technical support as well. He's very clearly telling you that the software is going to be functional. You don't need updates. The software is going to be functional. You don't need a technical support. That means I don't see any kind of interdependency or interrelationship between the software, between the updates, as well as between the technical support. And even the installation is something which is tailor-made to the needs of the client. So it seems that if I apply the step number B, and I start looking at the customer's point of view, I don't see that any kind of integrations is required. I don't see that in this case there will be any significant modifications which will take place, and I don't see that there is any kind of high interdependence or inter relationship which is there, which seems that we can treat every promise as a performance obligation. So how many performance obligations are there? I would say each and every promise in this case becomes a performance obligation. The provision of a license, the installation, the software updates, as well as the amount of technical support system, everything is going to be treated separately in this particular case. So every promise is going to be a separate performance obligation in this particular case. Let's see if we got some answers at your side so far or not. Yes, I think we got some things. Okay, now we got the input. Manav, you said in question number 14, okay, the software is not much used without updates. So I feel step itself give answer as no single performance obligation. Well, I would say there will be 2 kinds of customer. You can say if there is a customer number 1 who feels that the update of the software is really critical and he wants the update, then it is a single PO. But if you look at a second situation, a customer who feels that update is something which is, can be done away with, then it would be multiple PO. So it all depends upon the customer, what he wants. Is he looking at the criticality of the updates as very crucial? So if he's looking at the updates to be critical and he wants it, it's a single PO. Otherwise, it can be a multiple performance obligation. And I think, Shriram, you said, where can we get the education material? You can get it from the ICA website if you want, but you don't need to go through the entire education material. I think some selected questions, but you can get it from the website of the institute. Manav sir, my doubts are not reaching you suddenly. I think so. I just got it. So please, in question number 14, the software. Okay, I just got it. I think there was some lag in terms of getting the questions. So I think now it answers the question, I guess. And Sumit, yes, you rightly give the answer. Tushar, you rightly give the answer. And Manav, sir, but for a non-technical person, all documents are interrelated. No. You see, at the end of the day, even as a customer, I know that, these things are not interrelated, interdependent. I can't go with the convenience what the customer wants. I'm not saying that what the customer wants is not important. Now, let's see from your point of view. If you say in this particular case that the customer would, in question number 14, you're saying that the customer would always want an update. And he's always considered that it is critical in nature. Yes, I would treat it as a single performance obligation, but every customer may not think on those lines. But let me tell you, having said that, in terms of the application of step number 2, we don't go back to the customer. In major cases or a practical life condition, what is done, we just go through the terms of the contract. We look at what is documented in the contract. What the customer wants is going to be something which is going to be very visible in the terms of the agreement. The terms of the agreement will beautifully bring out what the customer wants. It is the job of the auditor to literally look at the contract. There are many companies, and not name them, but they basically do what? They just pick up the contract, put that in the software, and the software helps them to identify the performance obligation. The step number 2 is an exercise today which is done by artificial intelligence actually. Because over a period of time, so many contracts have been entered into that particular software that the software has become expert in terms of identifying, what are the kind of performance obligations, just like ChatGPT. Yesterday what I did, just for understanding, I just gave a question to ChatGPT yesterday, and it gave me an entry for the transaction where the debits and the credit side was not matching. Then I asked the artificial intelligence boss, you give me an accounting entry where the debits and credits is not matching. What kind of entry is this? The ChatGPT tells me, sorry, I'll give you a fresh entry. It generated me another fresh entry where it recorded a loss on the credit side of the entry. I said, boss, what is this? How can a loss appear upon the credit side of the entry? It should be appearing on the debit side of the entry. I said, I am really sorry. Let me bring another third set of entry. So it was really fun, when I started testing ChatGPT for all these things. That first the entry doesn't match, the double entry bookkeeping is gone, then the losses appear on the credit side of the entry. Okay, so we, the artificial intelligence does what we teach them, and that's what they deliver. Manav sir, right now I am also thinking question 16, license and technical support are interrelated. Well, since the question is very clearly telling you that the installation is routinely performed, let me ask you, if let's say there is a fire stick which you purchase and you just need to put it in the socket on the television, do you think you need that kind of highly interdependent, interrelated, mind the words in the para number 29, significant, highly interrelated, with the language that it is routinely performed? Do you think you will really rely upon an entity that unless you do this to me, it doesn't work for me? No. Then it also says that it is not going to significantly modify. So when he's using the word not significantly modify, he's indirectly giving you a hint that para number 29 is getting failed. And if para number 29 is getting failed, then each promise should be treated as a separate performance obligation, right? I guess that helps. That I think gives your answer to the question, right? Okay, wonderful indeed. So I think that brings us to the end of the session also today, friends. It was really enjoyable, interesting to have a good lot of things, but please do revise all what you've done today, because this is a crucial understanding in terms of step number 2. Our main focus has been on modifications today and on the step number 2. Step number 1 is done with the special issues, and step number 2 is done. In the next class tomorrow, I'm going to start my journey with the step number 3, which is again a very crucial step, that is a determination of the transaction price. Okay, no, I'm now understood. Thanks. Thank you, Manav. Tushar, nice session it was, sir. Thank you, Tushar. Means a lot. So thank you, all of you friends. I think any questions which have been unanswered, I guess no. Right, friends. So you're free to send your queries also on the email which you have got. If there are any kind of questions, it can be sent across in the email. I'll be shared with the questions and I'll be happy to answer them back to you. Right, friends. So I think on that particular note, I think we end the day. So we're going to see you back tomorrow. Thank you very much. Bye bye and take care. हाँ जी, ओवर हो गई। हाँ जी।